Hey, this is my friend John, and he's just setting up his new bookstore. And that's my neighbor, Peter. Peter is also setting up a grocery store business this month. John began his bookstore business with $10,000. During the first month, he had already rented out a place. He first found out where he could buy books at a good price. He then went ahead and purchased books worth $5,000, but he only paid $4,000 to his suppliers. The first customer that came purchased books worth $60, and he paid the full amount to him in cash. The next sale was for $150. Now this customer was John's friend, and so he promised to make the payment the next day. There were a lot of customers who came to buy books from John during this entire month. Now at the end of the month, John had to pay rent for his bookstore and pay for electricity bill. He also had to pay for printing of banners and for everyday tea and coffee expenses. Now what happened was the supplier came to take his money, and also the person who made the banners for him, and then the guy at the tea stall. Everybody was here, and John didn't have enough cash with him on hand. He had forgotten how much money to pay each one of them. He did not write it down or record any of the transactions that happened. He still had not received money from people he was supposed to, and he was helpless because he had no record of how much to pay and receive from whom. So John was in a total mess. He called me up yesterday and narrated his story to me, as I'm an accountant, and asked me to come down and help him with all the accounts. The first thing I asked him was, "Did you maintain any records, maybe just on a rough chit?" And he said no. So unfortunately, I had to tell him I would not be able to help him. On the other hand, I also met Peter that day, and he was quite happy with his grocery store. I asked him whether he was keeping track of his daily transactions, and he said yes. He had noted everything, but it wasn't systematic. So he asked me to manage his accounts for him in an organized form. He was quite concerned about his business. He showed me his records. These records were not helping him to know the actual progress of the business. He is unable to make decisions like what is the profit of his business, were his expenses too much compared to his income, and so on. This is where we need to work on the simple records and prepare some further reports that will help him to make these decisions. These were his records, and after a little classifying and analyzing, this is what I made out of it. Now from this report, you can see that he purchased grocery worth $6,000, and he paid his rent, electricity bills, and for tea and coffee expenses for a total of $1,000. So $6,000 plus $1,000, he spent $7,000, right? And what he received from selling grocery was $9,000. So he received $2,000 more than what he spent, which means there's a profit of $2,000. Now he initially invested $10,000, and we know that he made a profit of $2,000. So he should have $12,000 with him. So where is all this money? This table here shows that he has $9,000 in his bank and $3,000 with him in cash. So his balances are matching here. So by preparing these reports, we know the stand of Peter in his business. We know his profits, and we know exactly where is the money. These reports we made will help him to take important decisions in his business. So what did we learn from this story? John did not maintain any records, which is why we could not further help him to prepare any accounting reports, but Peter kept records. This initial records maintained is nothing but bookkeeping, which is the first step in making reports. And this whole procedure of keeping records, classifying, and analyzing to make reports which help in decision making is nothing but accountancy. Accountancy is essential for any business activity, like we saw in this case. But the knowledge of accountancy can also be applied in a lot of other everyday crises we might face, like where to invest your saved money, what's your household income and expenses, which car should you buy, loans, mortgages. The use can be endless. So that's all for today. Thank you.
Hello and welcome to this course on bookkeeping and basic accounting. I would like to give a brief introduction about myself. I've been working as an accountant and finance professional for over 14 years now, and I've been actively engaged in conducting trainings, workshops, seminars on accounting, finance, and relevant subjects. And our trainings have helped many professionals streamline their business and accounting challenges. This free course is designed for you. If you are a startup, an entrepreneur, a micro business, or you're working in any organization in finance and accounts division, or you're an online business, or you're looking for a career in accounts and finance, then this course is just for you. This course is designed for beginners. Let's discuss the course content. The first thing you will be learning is what is bookkeeping and why is it important for you to do a proper bookkeeping for all transactions you have made in an accounting period. Second thing we'll be discussing is difference in accounting and bookkeeping. The third thing would be the 5 basic principles of bookkeeping. Fourth thing would be what are the different types of bookkeeping. The fifth thing will be main elements of bookkeeping. In our 6th part, we'll discuss few requirements of compliance, audit and taxation, which is of course different for each country. 7th thing we will be discussing would be how basic bookkeeping leads to ledgers and trial balance preparation. And finally, 8th thing will be preparation of financial statements from trial. So let's begin the course formally to discuss how the whole accounting system works. Let's begin with our main discussion, that is what is bookkeeping. Bookkeeping basically involves the recording on a daily basis of companies' financial transactions. With bookkeeping, companies are able to track all the transactions of your business. At the same time, you get a trail for your transactions, and whenever information is needed, you can easily retrieve your information. Now we are going to discuss what is the difference in bookkeeping and accounting and a few more assumptions that are very important and critical for you to understand the basic accounting. Bookkeeping basically includes recording, storing, and retrieving of financial transactions of a business or a non-profit organization, or even if you are an individual business. On the other side, accounting is summarizing financial transactions and presenting the results in various reports and analysis, which is used for decision making. So basically, you're converting data into information. Now we'll discuss entity assumption. We consider business as a separate legal entity. Time period. Clearly mention intervals of time used to help in effective decision making. So basically, you are recording your 5 basic principles of bookkeeping. The first one is revenue recognition principle. Revenue is a gross inflow of cash, receivables, and other considerations arising in the course of ordinary activities of an enterprise from sale of goods, rendering of services, or use of enterprise resources by others, yielding interest, royalties, and dividends. So basically, you will be recording your revenue based on either sale of goods or maybe rendering of services or any other enterprise using your assets and paying you either interest, royalty, or dividend for that. Historic cost principle means that an asset is ordinarily recorded in the accounting records at a price paid to acquire it at the time of its acquisition, and the cost becomes the basis for accounts during the period of acquisition and subsequent accounting periods. So that means if you purchase an asset in 2018 and you are in 2020, you will, even if the cost of the asset has gone up, you will still be treating it at the cost on which you have purchased in 2018. The third very important principle is matching principle. The expenses incurred in an accounting period should be matched with the revenues recognized in that period. If the revenue is recognized on all goods sold during a year, the cost of goods sold should also be charged to that period. That means if you have made any sale or you have performed any services, then book all the relevant expenses that are relevant to that specific revenue. The fourth basic principle is full disclosure principle. The financial statements must disclose all the relevant and reliable information which they purport to present, so the information may be useful for the users. And last but not the least, objectivity principle. The accounting data should be definite, verifiable, and free from all personal bias of the accountant. In other words, objectivity means the objectivity principle requires that each recorded transaction event in the books of account should be adequate evidence to support it. Now let's discuss the types of bookkeeping. The first type is single entry system that is used for businesses that have minimal or uncomplicated transactions. This system records cash sales and business expenses that are paid when incurred. The second is double entry system used for businesses that routinely have more complex transactions, that collects income through accounts receivable and receive inventory on credit, and are better suited for this method. Bookkeeping softwares. Many small business owners use bookkeeping softwares to keep track of financial activities. This includes a wide range of softwares, starting from a very basic to very complex and sophisticated accounting systems like ERPs. The fourth type of bookkeeping is virtual bookkeeping. If the whole idea of single entry and double entry bookkeeping methods make you queasy, you might benefit from virtual bookkeeping services. The bookkeeper posts your transactions to appropriate journals and ledgers and emails you a copy of your reports. Now let's discuss the elements of bookkeeping. The first is double entry system, where we use the source documents to make the entries. The entries are firstly recorded in T accounts or journals, which cumulatively forms ledgers, and the totals of which goes to trial balance. And the trial balance is what we use to actually construct the financial statements. And finally, post-closing trial balance. That means once the financial statements are audited and the auditors identify any double entries or any errors or frauds or any transactions that has to be readjusted, then there are several accounting entries that are posted. Now let's discuss the double entry system. Double entry bookkeeping method in bookkeeping identifies the dual effect of each transaction of assets, liabilities, or owner's equity and record it in its books. The basic rules for double entry bookkeeping system is when there is an increase in asset and expense, you make it debit. And if there is any decrease in asset and expense, then you do it credit. And if there is increase in liability or owner's capital, or there is a sale, then you post an entry that is credit. And if there is any decrease in liability, owner's capital and sales, you put a debit entry. Next, we are discussing the source documents. Journalized transactions from source documents, original record containing the details of the transactions entered in the accounting system. The examples are sales invoice, purchase invoice, a credit note or a debit note, or any expense related voucher. The general is the book of original entry, and the transactions are journalized as soon as they are occurred. For example, Tom & Company sales good for $1,000 on 2nd February 2017. The result of this transaction is company's cash asset increases, that means debit, and sales income increases by 1,000, that means credit. So in that case, debit and credit is equal, and we have posted entry in two respective accounts. Applying rules of double entry to these transactions will debit cash and credit sales. Now you can see the same transactions we discuss in this generalized transaction format. This is how we actually post an entry. Then comes the ledgers. At the end of each day, the bookkeeper transfers the entries from the journal to the ledger. This is referred to as posting to ledger. That means all your entries have to go to their respective ledgers. The ledger consists separate accounts for all assets, liabilities, owner's equity, income and expenses. Collection of those accounts are called the ledger. A ledger account has two sides, left and right. Left side is for debit transactions and the right side is for the credit transactions. Now you can see this is the ledger. So for the entry we posted for cash of some items, you can see on the debit on the right side you see entry of 1,000, and on the left side you see transaction of 1,000 as well. So it's equal transaction. Now let's move to trial balance. Trial balance is called trial balance because it's the first step towards preparing the financial statements of an entity. It is generally used to check all of your entries have been passed and there are no errors in the books. Trial balance is a list of closing balances of ledger accounts on a certain date and is the first step towards the preparation of financial statements. It is usually prepared at the end of an accounting period to assist in the drafting of financial statements. The rule to prepare trial balance is that the total of debit balances and credit balances extracted from ledgers must tally. That means they are exactly equal. Advantages of trial balance. The trial balance proves the arithmetic accuracy of the books of accounts by checking and comparing debit and credit balances. Debit and credit balances are identical. It ensures that the transactions recorded are accurate. Now you can see on the screen that for example, for the first entry we passed, cash was debit and sales was credit. Then we booked sale return of rupees 10, that is booked on the debit side. Purchase of 100, that's again booked on debit side because it's an expense. And purchase return, so that is booked on the other side. Inventory, equipment, drawings, selling expenses, all of these are booked on the debit side. And we have booked credit of 1,000 and owner's equity for $230. So you can see that the debit side of trial balance exactly matches the credit side. That means this is a closing trial accurately prepared. The totals of debits and credits of the trial balance should be equal. Then the trial balance is in balance. The trial balance may be out of balance, and that can happen only because there is error in posting. For example, missing posting entry to one ledger of account means you have entered in debit side but forgot to enter in the credit side. Or debit both accounts. Instead of crediting one account, you have actually debited both same accounts. Or debit and credit different amounts. So means there is an error in the booking of the amount. So in that case, when you have actually made any error, we pass adjusting entries. Adjusting entries are journal entries used to correct errors in posting. So we remove the errors that we have faced, that we have unconsciously put in the accounting system, we correct it and use to record the physical inventory balance at the end of the period. So basically, this is how we correct any errors in posting. Now you can see this is an example where there's in adjusting entries posted to rectify the error we have occurred. Adjusting entry cash debit to 10 and sales to 10, it was a error correction. And revenue and expense summary 300 and inventory 300. In the second entry you can see 300 entry of 300, which means that inventory was incorrectly posted. We did an actual stock take at the end of the period and we found out that the inventory was actually overstated by 300. So we corrected it with posting a entry in the revenue and expense summary. So let's discuss what are the financial statements. We will start with the purpose of financial statement, which is to provide information about the financial position, financial performance, means profit and loss, and cash flows of an entity that is useful to a wide range of users in making their economic decisions. The complete set of financial statements compliant with IFRS, which is the International Financial Reporting Standards, comprise of 5 elements. The first is financial position at the end of the period. That means the actual position of the business with all the liabilities, assets, and equity. Means it is the balance sheet of the company. A statement of comprehensive income for the period. This is the profit and loss account for the period. Statement of changes in equity for the period, which we discussed earlier as well, which tells us how much equity the owners of the company injected to the company, how much dividends were paid, and what other transactions happened related to the equity. A statement of cash flows for the period, the opening cash flows and the closing cash flows, and all the activities related to operations, financing, and investing activities. And the last part is notes, containing a summary of significant accounting policies and other explanatory information, which more or less defines all the above 4 things in detail. Now the fundamental principles for financial statements are the fair presentation. That means it's truly and fairly presented. It is compliant with financial reporting standards, and it is prepared on going concern assumption. Also, accrual basis of accounting has been adopted. It defines materiality and aggregation, offsetting, frequency of reporting, comparative information. That means that you have to provide information for the past periods as well, and consistency of presentation for each period. Now let's discuss how we identify the financial statements. Basically, every element of financial statements shall contain the name of the reporting entity. That this report is related to XYZ company. The information whether the financial statements are of an individual or a group of companies, the date of reporting entities, and the period covered, the last date when financial statements have been prepared, the data that has been used, as we earlier discussed that financial statements are prepared on historic cost basis. So we will be mentioning what is the date of reporting entity and which period is covered in that specific financial statements, the presentation currency, and the level of rounding. Whether you are rounding it to 2 decimals or less than 2, you have to mention that in the identification portion of financial statements. Now let's discuss what is the statement of financial position. International Accounting Standard 1 requires presentation of classified statement of financial statements where current assets or liabilities are separated from non-current assets and liabilities. Basically, the asset or liability is current when it is expected to be recovered or settled within 12 months after the reporting period. The second part is Statement of Comprehensive Income. It has two basic elements. The first is profit and loss for the period, where all items of income and expenses must be recognized. The second portion is Other Comprehensive Income. Items recognized directly to equity or reserves, such as changes in revaluation surplus, gains or losses from subsequent measurement of available for sale financial assets. This portion we will be covering in some next course, where we will be explaining all these elements in further detail. The next portion, Statement of Comprehensive Income, provides the profit and loss for the period and some further details like attributable to non-controlling interest and attributable to the owner of the parent. This is basically an advanced level of financial knowledge that I already mentioned we'll discuss in some other course. Now let's discuss Statement of Changes in Equity. As a minimum, the Statement of Changes in Equity must contain the following items: total comprehensive income for the period, that the total of the amount that we prepared in the last statement, showing separately amounts that are attributable to the owner and attributable to those who have very limited number of shares or the non-controlling interests, and the reconciliation between the carrying amount at the beginning and the end of the period of the component of equity. And it also, the standard prescribes to present amount of dividends recognized as distribution and related amount per share on the face of the Statement of Changes in Equity and in the notes. That means whatever dividends you have earned, that has to be mentioned in the same statement, which is the Statement of Changes in Equity. Now we'll discuss notes to the financial statements. Notes are meant to be the documents accompanying numeric financial statements listed above. They should provide additional information that is not contained in the numbers, the basis of preparation of financial statements, and some additional information that might be relevant. The Financial Reporting Standard sets the notes shall contain a statement of compliance with Financial Reporting Framework, summary of all the accounting policies applied, and supporting information for numbers presented in the financial statements, and other disclosures as required by Financial Reporting Framework or your legal. Thank you so much for listening to the whole course. Congratulations, you have learned some basics of accounting and financial statements. Now let's summarize what we have learned in this period of 30 minutes. So we discussed what is bookkeeping, what is the difference between bookkeeping and accounting. We also discussed 5 basic principles of bookkeeping, what are the different types of bookkeeping, and what are the basic elements of bookkeeping, in which we discussed various concepts. And the last portion was when is the time to hire an accountant. We also discuss some examples on how double entry system works, how source document is the base of your journal transaction, how the journal transactions goes to the ledgers. Ledgers form the trial balance, and trial balance actually, and finally prepares financial statements. We also discussed what are the financial statements as per financial reporting standards, in which we discussed the 5 set of financial statements that is compliant with reporting standards, and what are the important elements that financial statements have to cover to achieve fair presentation. And thank you once again for listening to the course. And if you have any questions, any queries, please write us. And thank you one more time. See you in our next course. Bye. Now let's discuss the accounting cycle. As you can see on the screen that the step 1 is identifying and analyzing a transactions. Second step is general entry for that transaction is posted. The third step is the posted entry goes to the ledger. And in step 4, an unadjusting trial balance is prepared. From that, you prepare a worksheet. That's most of the times made in MS Excel. The sixth step is record adjusting general entries. That means if there is any error or recording mistake that you adjust it. And eventually you reach the adjusted trial balance. That means that's the corrected and more reliable trial balance. Now this trial balance is actually used to prepare the financial statement. And then we actually post some closing entries, and the closing trial balance is actually adjusted. So it comes that we actually post the adjusting entries pre-closing to the trial and post-closing as well. Now let's discuss what is a financial statement. Financial statement comprises of 5 important statements. The first one is income statement or the profit and loss account. It's also called statement of financial performance for a specific period. The second important statement is your position statement or your balance sheet. That tells you what exactly is your current situation in terms of assets, liabilities, and capital. The third statement is a cash flow statement that gives a trail for opening cash to closing cash. Fourth statement is statement of changes in equity, in which all the transaction related to owner's equity are recorded. The last is explanatory notes and disclosures. In notes or disclosures, you elaborate all the entries or transactions or events happen during the year, or anything that needs more explanation or clarification related to financial statement or financial statements including financial position and financial performance. Now let's discuss the requirements of compliance, audit, and taxation. The requirement of compliance requires that in order to legally operate, businesses must comply with certain requirements regarding the company's transactions, labor practices, and safety procedures. Before launching your business, you should know the appropriate regulations for your industry while making sure to keep a log of any costs and dates related to their compliance. Requirement of audit. Auditing is an objective evaluation of the financial reports and reporting process of an organization. The primary focus of financial audit is to provide assurance that to the investors that the financial statements are accurate and truly and fairly presented. The auditing of your company is a positive process. It will enhance the confidence of people on your company and improve credibility of your accounting system. Requirement of taxation. As a business owner, it's very important for you to understand your federal, state, and local tax requirements. This will help you file your taxes accurately and make payments on time. The business structure you choose when starting a business will determine what taxes you'll pay and how to pay them. Now let's discuss the last point of our discussion, that is when to hire an accountant. A full-time accountant basically. Small businesses accounting can quickly become complex if you do it on your own. If you feel you're losing control of your owes, your money, or how much, an accountant can help you get back on track. So basically, when you're looking for an accountant, keep these points in mind. Hire an accountant when you're ready to delegate your work. Hire an accountant when you have to deal with the government. And hire an accountant in case you are audited or you require to file an audited report to the compliance reg authority. You'll need an accountant when you apply for a business loan or an overdraft, or your business is growing very well. Hire an accountant, or get an accountant's advice before you take on a franchise, or also get an accountant's advice before you buy a business or you are planning to sell your business. At that point, get advice from your accountant. Thank you so much for watching the course. I hope this was really helpful for you. If you have any questions or any queries, you can always reach out. Thank you so much for your time. Take care.
Okay, so what is accounting? What do you know, even though you are not from the finance background? So what is accounting for you? Huh? Yeah, calculating what? Income and expense. Yeah, so correct. So you can say accounting is basically for most of the people says like creating the profit and loss statement. How much is your income, how much is your expense, what is your net profit. So that is the normal perception for accountants, but there is much more than this in accounting. So accounting is basically maintaining the records. So we will look at the definition. So, but we just need to clear the accounting, the fundamentals. So who needs accounting? Who need to do it? Everybody need to do. But mostly is the physical job is the accountants, right? But who need to do? Every business need to do it. Even though you are a not for profit organization, you are a profit organization, you are a government organization, you are a startup, everybody need to do their accounting, right? To know how much is your income, how much is your expense, how much assets you have. So do you know in your family business how much is the value of assets you have? You don't need to tell us, but just answer yourself. Do you know how many millions of dollars you have now? I don't think small. Huh? I always think big. So you will not see me using 100,000. I'll always use millions and billions of dollars. Okay, and also in dollars, not in Myanmar chat. So you need to know that, so that you know how much you have, where you can invest, and how you are going. What is the return on your investments, right? And why do we need it? As we know, for understanding your profit and loss, understanding the returns, how much money you are earning, are you earning enough or not, right? If your business is earning less, if you have invested, let's say $1 million in any business, and that business is giving you $10,000 a month income, will you be happy? No, right? Why? How you say no? How you compare? How much you want? So means you need to have a target, right? So you may have a target based on, let's say, bank interest, you may target based on other business opportunities, or you may target based on another investment profile that you want to use, right? So you always want to compare your returns, what you are getting, compared to your targets. So, but how will you calculate how much is your actual returns? So actual return is very difficult to measure, and it's very subjective. It depends on what are you looking at. Are you looking at cash flow, or you're looking at accounting profit, or you're looking at value? There are three different concepts of how much money we are getting. You may be investing in a real estate business where you're not getting much rent, but your value of your building and land is increasing very significantly, right? And there is another investment next to it which will give you a lot of rental income, but at the end of the day your land and building value is actually dropping. So which one you will prefer? It depends on, there's no right answer, it depends on your objective. Do you want a regular cash income, or you want value increase? Correct? So it depends on the business objective. What are the business objective? Okay? And who are the target users? So everybody is a target user. Everybody need to understand it, be it from the CEO, the business owner, even the staff of the company. The government need to know how much you are earning, right? So that they can collect the right tax from you. I'm sure not everybody is submitting the right tax, because you have 2 set or 3 set of the financial statements, right? In your real life. That's real life, right? That's Myanmar, or even in where I come from, India. We never submit our 100% tax. We submit only 20% of income to the government, and we pay the tax based on that. But government want to know, right? So government finds a way that how to know that how much income you are earning. So government is also trying to understand what is your income levels. Staff need to know, will you be able to pay salary next month or not? Correct? So they also need to have a financial statements. If you are a startup, maybe somebody who is a high profile job, let's say somebody who is established job person who gonna leave his job and come to your company, he need to know how long you will be able to pay the salary. So how he will know? He will look at your financial statements, right? He cannot look at your bank statement. He will not ask you, because if he asks you, yeah, sure, we will pay, don't worry. And then for 1 year, you don't pay the salary. But if he has access to your financial statements, he can know. There are indicators that the company is sound enough or not. When you are investing money into the business as an investor, you want to know the company is sound or not. The money you are put into the company is worthwhile or not. Correct? So from the investor perspective, staff, creditor, whoever is selling you anything for credit, he also need to know this company can pay money on time or not. Correct? So there are a lot of indicators that we will learn today, how to understand that company is solid or not. Okay? So this week we are going to be focusing only up to this part. Next week we'll learn more advanced topics. Okay, so what is financial accounting? So financial accounting, you can assume, is like a process. Okay, so the process starts from recording the financial transactions. So what is a financial transaction?
How much you gain, how much you get, and how much you.
So that is correct definition, but financial transaction means anything, any business transaction that you do which involves money. So you may be paying money physically, or you may not be paying money, but you may have to pay in future. So anything which relates money is financial transaction. Is it okay? Very hypothetical example. Huh? If you love your girlfriend, is it a financial transaction? No, right? You are just loving. There is no money involved. Yeah, you have gifts, but that is not the transaction, right? Correct? So that is not a financial transaction. But if you give a gift to your girlfriend, is that a financial transaction? Yes. That is a financial transaction because it involves money or something which can be measured by money. Okay? So any transaction when a business does which can be measured by money, it is a financial transaction. So it needs to be measurable. So love, emotions, They are not measurable. If let's say you are creating a brand, right? You have a business. For example, let's say Apple. Apple is now worth $1 billion in their brand value. Okay, but if you look at in their balance sheet, there is no money, there is no asset called Apple brand value. Why? Because they are creating it. They are just making it. They didn't buy it from anybody, right? So that becomes their brand value. So creating a brand is not a financial transaction, but buying a brand, paying money for a brand, it is a financial transaction because you are paying money. You are measuring it by some way somehow, right? If you have your own brand, you cannot measure your own brand, or you cannot record, you are not paying to anybody, correct? But if somebody else is buying your brand, it is a financial transaction. So we always record only financial transaction. We don't record non-financial transactions. So when you hire a staff, correct? The staff value is much more than what you pay to them, correct? The staff, the salary is, you are paying them, maybe let's say you hire $1,000, but you know that the skills are valued more than $1,000, correct? But so are you recording $1,000 or more than $1,000? You are not recording for the skills. You are recording only for the money that you are paying to them, correct? And after you have recorded these financial transactions, only financial transactions, the next job is to organize the transactions by account for business decisions. So how you record, how you organize your transactions. So the transactions can be recognized, for example, revenue segmentation, where you are getting your money from. Who are your customers? Are you getting money from Japan, from Australia, from Singapore, from where are your customers coming from, right? So the segmentation means who are your customers, different type of customers. Okay, so we're going to be learning revenue segmentation later. What are the more details in revenue, how we segment the revenue. But the business earns money from different sources. So every different customer who is paying you, not every customer is going to pay you more money, right? They may be paying you different values. For example, airlines. Somebody is traveling in business class, somebody is traveling in the economy class. So it's the same plane, but the airline is getting money from two different sources. One who is flying in the business class, one who is flying in the economy class. But if they don't segregate, they have no idea at the end of the year, was business class successful or not? Correct? If nobody flies in the business segment, so what they should do? They should kick off the business class and put everywhere only economy, because nobody is flying business, right? So business segmentation is very important to understand where your money is coming from and where you need to focus to make it even more, even better. What type of customers paying you money, and what type of customers can pay you more money, correct? And also the segment cost center means profitability. Your company may have different type of products. Your company may have different departments. So you want to know what type of products are giving me better profit, or what type of departments are giving me, what type of business are giving me major profits, right? Not just only that, okay, if I have 10 businesses, I continue to run all 10 because I don't know which one is profitable. But overall, I'm making profit. Okay, so let's say there are 10 businesses. 2 businesses are making $1 million each. So you make 2 million. Other businesses are losing 100,000 each. So in the net, you still make money, right? But if you don't segregate, you have no idea. If you segregate, then you know, okay, we keep these 2 and we kick out the other 8. So we can save, so our net profit will be 2 million rather than 1.2 million, right? So we want to segment the revenue. So how you will know that? By segregating the transactions into each profit center for each segment of revenue, so that we can understand the business position. What is our existing business position? And finally, we group all these transactions into financial statements. So the financial statements includes your profit and loss, your balance sheet, and your cash flow. So there are 3 major financial statements that we use in our business. One is profit and loss statement, one is balance sheet, and one is cash flow. We're going to look at the sample template for that. And in a periodic interval is usually we do the grouping at least once in a year for tax purposes. But business can generate their profit and loss statement every month as well. You can do it even every week if you have a lot of staff, and they can generate it if you're using systems. But if you're using manual accounting, you cannot do it every week or every month. It's very difficult, right? So it's mostly we do it every month or once in a quarter. So the accounting works on a double entry system, like human. We work on two legs, right? If we have only one leg, we buy another one, but we have to have a balance. So the accounting also works in the same way. It has to have a balance. Two transactions, two leg of transactions. Okay. So two double entry system. So every transaction has two sides. Even in a real life transaction, if you are giving something, you are getting something back. Correct? Which is measured in value, which is measured in terms of money. When you are selling something, what are you getting back? And what are you giving? Your product or your services, correct? Which is measured at the same value, correct? In olden days, when we were doing the transactions, when there was no money, we used to barter, correct? You take my laptop, I take your laptop. Or you take my rice, I take your meat, correct? And the value was like this, same, we work in the same way, right? We sell something and we get something back. So accounting works in two ways. One is something we going out, something is coming in. Either we receiving something physically or right, or we can call it our gain, right? Whatever we are making, or in return of giving something back. So it can again be physical, or it can be only a right. So we have two transactions. One is we are giving and one is we are getting back. So we need to record both sides of transaction at the same time. Otherwise your accounting will stumble, okay, if you have only one leg. For example, sales, either we can sell in cash or we can sell in credit. Okay, how we are going to record, we will look at the next slide, but at the time you just understand there are two types of transactions. What we give is our goods and what we get is cash or right to receive a cash in the future. Hiring a staff, what we get? Services from their staff, which is valued equal to the salary that we are paying, correct? In real life, the staff is giving much more value to the business, more than what you are paying to the staff, right? But you cannot record that extra. You can record only up to the level, up to the salary that you are paying. Okay. So to record the transaction, we use something called T account. So the T account means it's like a one account. So where we record one side debit, one side is credit. So you can use debit side, credit here, debit there, or debit here, credit there, it doesn't matter. What matters is that both sides need to be same, because we are using two sides of transaction, right? So how we use it? Every financial transaction has two sides. Debit means something receiving, mostly means coming in. Whatever comes in or whatever we get, normally we record as debit, or we expense, we lose. Whatever we give back to anybody, we normally record as credit. Okay, in accounting term, credit means your liability or your gain, and debit means your assets, whatever is your right to receive in the future. Okay, so there are some fundamental rules which you need to know when you are recording the transactions. So the rule one is whatever coming in need to be on the debit side, and whatever is going out need to be on credit side. So in the previous example, we look at sales in cash. So what went out from our organization in sales? Your goods, correct? So what will be the accounting? If let's say we want to record accounting transaction, what will you record? How will you record it? What will be the credit? Sales, right? Your sales or your goods, that particular good will be credit. And what will be the debit? What is coming in? Cash is coming in, right? So the accounting entry, so we call this one financial transaction, one accounting transaction. These two sides will form of one transaction, right? So debit, cash, credit, either sale, or you can call it that goods name, whatever you are selling, or services. You can say consulting, you can say anything that you are selling. Okay, so that means this is one transaction. The second rule in accounting is debit the receiver, means whoever is receiving the money from your side, he should be debit, and credit the giver. Whoever gives the money to us will be credited. So if let's say you sell something on credit, now the person is paying you the money, correct? So in this case, what is happening? Who is giving the money? The customer, correct? So you will receive, you will debit, you will credit the customer, and what you are getting back? You're getting in money. So you are using rule 1 and rule 2 together. So it's not necessary that one transaction will follow only one rule. The one transaction can be affected by two different rules. So here, if you receive money from your customers, you are basically receiving the money from credit the giver, means whoever is giving the money will be credited. But what will be the debit then? That is not written in this rule, right? That is written in this rule. Debit what comes in. Okay. So whatever is coming in means cash is coming in. So the accounting transaction will become debit, cash, credit the person who gives the money. Okay. Rule 3 is debit all your expenses. Whatever is your expense, whatever you spent is your debit side, and whatever is your income, you may be selling something, right? So that is your credit side. Okay. The last rule number 4 is debit all your assets, whatever is you hold. If let's say you buy a laptop, you buy a house, you buy a car, it always will be debited, because you are getting in something, right? And in return you are paying something. You are paying money, so that will be credited. So these all the accounting transactions, the whole accounting transaction will follow only these 4 rules. These are like foundation. Okay, so you can either take a picture or you can note it down so that you remember. At the end of this, we will do a little exercise to understand these rules better.
I have a question. I don't really understand rule number 3.
Debit expense and credit income.
Yeah, because you said debit is what comes in, and expense is what you give. So why is debit the expense?
Okay, debit expense means that's why it's a rule, because there's rules are rules. So debit expense means expense is what? What is your expense?
Salary.
Yeah, salary, right? So you are giving salary. So but you are not giving salary, you are giving cash. Correct? So it will follow rule number 1. Cash going out. But what is coming in? Nothing. Your only services are coming in, but you cannot record services, right? Those services are your expense. You are hiring a consultant to do a job for you, so that is an expense for you, right? So that expense will be debited. So debit the expense and credit the whatever is going out. So if you are paying in cash, you are paying in credit, that will be going out. So expenses will always be debited. Means you are using the money for your business. So it can be rent, it can be salaries, it can be printing and stationery. So you can say a contradicting rule. Let's say you are buying a stationery from outside, right? So what is coming in? Stationery. So that will follow the rules, right? Debit what comes in, or it can follow the rule debit expenses. So stationery, when you buy a pen or pencil from the market, it's an expense for you. But you can follow rule number 1. What is coming in? Pen is coming in. So you debit pen, credit money out. But pen is what you are going to do with the pen. You're going to use in your business, right? And that you can record either as an asset or as an expense. So what you will record as an expense and what you will record as an asset depends on the business, depends on the size of business. So the process of accounting is this 4 steps. First is we record the transactions. Okay, we record the transaction into journals. So it's like a diary. You can record in a diary whatever is happening. You record both sides of the transaction in your diary, like a daily journal. Okay, like a logbook. So all the cash, sale, purchase, whatever you do in your daily transaction, you just need to record in your journals. Okay, and then in chronological order, means as they happen. Not that, okay, tomorrow transaction is coming first and today transaction will go later on. It's not like this. It has to have a time series. Whenever you are spending, it need to be recorded in the exact same order. Otherwise, you may mess up your books of accounts. Okay, it usually happens when you are recording all your, let's say, 1 week transaction at one time. So you may record whatever happened has on this Friday first, and whatever happened on the previous Monday first later. In this case, you may have problems with your accounts. It will not show you the right balances. So chronological order is very important. It need to be recorded in a day by day manner. Exact sequence. Sequence is important. Then we draw something called general ledger. Okay. The general ledger shows the journal by account. So here in this first case, we record in a logbook all in one account, but we don't segregate. We have not yet segregated the transactions. So we don't know how much total salary we paid, how much total rent we paid, how much total money we spent on printing, how much money we spent on traveling, how much money we spent on food. So what we do is we create some buckets like containers, small containers, right, to segregate all our expenses into the containers, like-minded containers, right? All red come in red, all blue come in blue. So all salaries go into one account, all the rents come into one account, all the printing stationery come in one, all our assets come in one, all our buildings come into one, all our liabilities come into one, all sale go at one place. In the bigger container like sale, you can have small containers, by customer, by product. So you can record the sale into different small further details, further segments. But segregation is very important. The general ledger works for segregation, segregating the similar transactions into the same way. Okay, and then finally the third step is we draw a trial balance. So the trial balance is nothing, it's just a summary of all your general ledgers. So what trial balance is doing is record all your transactions. You created all the buckets, so it will create a summary. Just list out total salary how much, total rent how much, total cash how much, total sale how much, whatever it is, and then it will tally up together. So the total of trial balance will always be equal. So trial balance will have two sides, one something with a debit side, one something with a credit side, or you can solve it, some will be in minus, some will be in plus. So the total of trial balance will always be 0. It's a checksum, just to make sure your accounting is correct. If it's not 0, means your accounting is not correct. Someone did something wrong. So if that happens, then a further investigation normally goes in to see where it went wrong. Okay. And then the last step is to draw financial statements from our trial balance. Okay. The trial balance will have assets, will have liabilities, will have income, will have expense, all 4 type of transaction into one. And then finally we segregate into different statements we call financial statements. So financial statements are 3. One is profit and loss statement, one is balance sheet, and one is cash flow statement. So what what profit and loss statement tell us? What does profit and loss statement tell us?
It tells us whether your business is making money.
Yeah. How much money you are making, how much money you are spending. And what does the balance sheet tell us?
Your assets.
Your assets and liabilities. How much you have and how much you own somebody, right? How much you own and how much you owe. Okay, so this is an example of a journal. So how a journal look like? So the journal will have 4 columns. One is date. So it's gonna have like, okay, 1st of January, 2nd of January, 15th of January, 31st of January. Then we'll have accounts. What accounts are getting affected? So in the first transaction, what is happening? What are we doing in the first transaction?
Buying material to build products.
Yes. So you are buying a material, right? It's already written there, material to build products. Correct? So what you are doing here is you are buying some materials on credit. Correct? Because you are not crediting cash. So means you are not paying cash. You are just crediting to payables. Means maybe a supplier. Correct? And the second is you are doing a advertising expense, right? You are doing some advertising in somewhere online. And then what is the third transaction? Third transaction is selling on credit, right? So you can already tell is it on credit or cash, because this debiting receivable means you are not getting the cash immediately, right? So you are selling on credit. And the third is you are paying salaries, correct? So this is very simple, correct? Now everybody is clear on journal. So once you draw up this journal, we will segregate the transaction into journal ledgers. So here's an example of few journal ledgers. So we have cash on hand, right? So we have two sides. You can see one is debit and one is credit side, correct? This is debit side and this is credit side. So all the transactions which will happen on any day, if it's hitting debit side, let's say inventory is debit, right? And payable is credit. So we will in our journal, inventory will be debited and payables will be credited. Whenever we pay to the supplier, we will debit them because the cash is going to be credited, right? So cash is going to be credited and debit will be your account payable. We just put into the buckets, okay? And then we see what is plus or what is minus. So you can assume debit as plus, credit as minus, and you will total it up to see what is the balance. So here is the balance. At the end of the day, you can say, okay, balance. What is the balance? Some accounts, some general ledgers by default have debit balance. Some general ledgers by default have credit balance only. But there are exceptions. You can have a credit balance of cash. Can you have a credit cash? Can you have a credit balance in cash cash in hand? What will be the meaning of a credit balance in cash in hand? When you debit, what do you debit the cash? When you debit the cash, when you receive it, right? And when you credit the cash, when it goes out from your pocket. So can you have more credits than your debits? How? You are printing money? Means you are receiving, let's say, $100. Can you pay 120? Cannot, right? So cash account cannot have a credit balance, correct? Unless you are printing money. If you are printing money, then it's okay. You can have a credit balance. But if you are not printing money, you cannot have a credit balance, correct? So some transactions by default will have a debit balance. Means whatever you have assets, you cannot pay more than what you have, right? And creditors will normally have a credit balance. Suppliers, they owe you. Let's say you buy from some outside supplier for anything for $1,000. Will you pay them 1,100? No, right? You will always pay either 1,000 or lower than 1,000. Correct? If I am there, I would pay lower than 1,000. I will ask for discount, not extra. I will not pay more. So suppliers will always be credit. Your customers will always be debit balance. Your cash will be debit balance. Correct? Your expenses normally will be a debit balance. Your income will always be a credit balance. So there are certain standards by default because of their nature. But you can have exceptions. So this is how the transaction works, and then finally you will have a trial balance. It's just noting out the balances in each account. So cash, how much is the balance left? Normally will be debit. Receivables, how much is that balance, means how much our customers owe us. Sales, how much sales we did, so it will be a credit side. Payables will be always on credit side, right, because we owe them money. Then you have cost of goods sold and inventory. So these are the total balance, and then we make a total. So make sure these two totals are exactly same. If this is different, if one is 17,000, another is 17,500, then your accounting is not correct. Something is going wrong. Okay, maybe you missed some transaction, or maybe you missed a total somewhere. Maybe you didn't do a totaling properly. Maybe your calculator was wrong, right? But nowadays, in today modern world, because all the accounting is done by softwares, all there are online cloud softwares, so you don't need to worry about it, because they will not allow you to record a transaction which is not going to be tally together. So this problem is very less nowadays. The trial balance always tally. You may record in wrong heads, but the total will always be tally. Okay. So then after we do the trial balance, the fourth step was to draw financial statements. Okay. So financial statements is like a movie, or you can call it a snapshot. So there are three financial statements that gives you different views. So one is the balance sheet, which gives you a snapshot. So snapshot means still, the still picture. It just gives you the current position, how much money you own, how much money you owe. And the profit and loss statement is like a movie. It will tell you during the year what happened. So that is why if you notice any financial statement, you can list out any public company financial statements. You will always see balance sheet is always on a particular date. The balance sheet is never for 2017-18. So now the government is changing financial year for 1920, right? So when at the end of 2020, you're gonna make a balance sheet. So balance sheet is not for 1920. Balance sheet will be always as at a certain particular date. So balance sheet is always on one date. It is never for a financial year, never for 6 months, not for quarter, never. It will always tell you something at one particular date. And profit and loss statement is for a period. It can be for 1 year, it can be for 6 months, it can be for 3 months, it can be for 1 day. So income is like a movie. It will tell you during this period of 1 year, what was our income, what was our expense, and how much was our profit. Okay. And cash flow is like your wallet. How much money do you really have in your pocket as of now? Okay. So in your financial statements, you may be making loss, but you may have cash in your pocket. Because, so what can be the scenario? Can you give me anything? Can you think of any scenario where your business is actually losing money, but you still have money in the cash in your pocket?
So you have debt.
Because you are borrowing the money, right? Payables. Or you are not paying money to your supplier. Only one accounting equation in accounting. Only one equation. Unlike mathematics, you have parabola or other things in engineering, but it's only one here. Assets are always equal to your liabilities plus shareholders' equity. Okay, that is the basic definition. Assets will always be equal to your total liabilities, whatever you own to somebody else, or whatever money you have put into your balance sheet. So the balance sheet is made up of three components. One is the asset, one is owner's equity, and liabilities. Okay, so this segment, it can be larger for owner's equity or can be larger for liabilities, but assets will always be the same. So what does it tell you? It tells you how you are funding your assets, where the money is coming from to buy the assets. It can come from your own pocket, means owner's equity, or it can be borrowed from outside. It can come from debt, it can be from your suppliers, it can be from anywhere else. So total is liabilities. Okay, so that is the basic definition in accounting, and everything follows it. Okay, sorry. So the extended definition of accounting is, because we have something called, so here in this balance sheet we are not recording sales or income. So this is something called extended definition. So expanded definition is owner's equity can further be divided into your original capital. Your paid in capital means the money that you started the business with, and net income, whatever you have been earning. So if from your income you pay any dividend, means you withdraw money from your business, that is minus. The rest will go back to your owner's equity. Okay, so the owner's equity, net income will take care of your revenue, your cost, and everything else. So this is how the profit and loss statement and balance sheet are merged, or you can say are matched together. Okay, so balance sheet is the ultimate document. Profit and loss statement is one step prior to balance sheet. To arrive at the balance sheet, you need to make an income statement to see what is your income and expenses and total income. If you have taken money from your income, means the dividends, that also you can minus, and the balance will go to your retained earnings. Okay, clear? So now you can draw the balance sheet. Okay, we will do a bit of exercise. So this is an example of how normally an income statements look like. So normally you have a sales, you have a cost of sales, gross profit, and then gross margin, and then we normally have selling expense and operating income, depreciation, amortization, interest expense, taxable income, then we pay the taxes, then we have a net income and the net income margin. So why do we have this separately? What is the meaning of gross profit?
Overall profit.
Not overall.
It means, let's say, if I buy something for 100 and sell it for 150,
Yes.
gross profit is 50.
So that's gross profit. Before making out any administrative or selling expense,
Net is when you subtract like salary.
subtract other expenses. So when you are subtracting your selling, so gross, why you want to know gross profit and why you want to know other net profit separately? What is the logic?
And you can tell your operation costs, meal overhead.
Operation cost also, and your pricing.
Yes.
Are you pricing your product properly or not? If your net profit is loss, let's say for example, see, pricing means it depends on your customers also, right? How much your customers are willing to pay. If let's say you buy something at $100 and you are selling it in the market, the price is 120, you cannot charge 130 because your expenses are another 20 to pay the traveling or other selling and general expenses, right? So you cannot charge customer 130 because your expenses are high. So what do you mean? It means what do you need to do? Either reduce your purchasing price or control your expenses. That's the only way. Selling price will not be able to increase because of the competition, unless you are the only one in the market who is selling. If you are the only one in the market, go ahead and increase the price. But if you have other competitors, you will not be able to increase the price unless you add more value. Maybe you want to add something more, make it more nicer, make it more better, make it more easier for consumer to use, add value, then you can charge more, otherwise you cannot charge, correct? And then the other expenses, to see how much is the percentage of other expenses. So you can compare the businesses, different businesses or different business models with the help of profit and loss statement. How the two different business models are comparing. Somebody may be manufacturing everything by themselves, so they don't need to do a lot of other expenses, right? Maybe they are not, if let's say they are manufacturing themselves, they need to have a factory, they need to have a fixed labor cost, they need to have a lot of land tax or other licenses, or otherwise they can go and buy from the market directly. Then they don't need to have a factory, they don't need to have administration, they don't need to have a lot of staff, so they will save, but the cost of buying will be higher. So you can assume two different businesses which are having two different business models. One is buying directly from the market and selling, no administration, no fixed cost. Another business is doing everything by themselves, buying raw material, making the material, and then selling it, and may also have a marketing expense, right? So there are two different models. So you can compare the profit and loss when you are looking. So their gross profit will be different, and net profit may be different, may not be different, right? Maybe if they say totally they are spending the same money, you are doing everything by yourself, but the profit remains the same. So you can judge which model is better for you, and when. Okay, you may be if you are in a trading business, you can be selling branded products or unbranded products. If you're selling branded products, you may not need a lot of marketing, because the marketing is done by a brand. But if you're selling something unbranded, you need marketing, right? A lot of marketing expense. So the segregation between cost of goods sold and the selling and general expenses help you to understand the benefits or the disadvantages of different business models. Okay, then the other are interest and depreciation. So we call this operating income. Why we don't include interest in operating income? Any idea? What is the meaning of operating income and net income, taxable income? Now a lot of businesses are putting depreciation as selling, general and administration expense. Some business they still separate it up, but that's a different discussion. What I want to put you is operating income. What is the difference and interest expense? Does it make any difference on your business if the money is coming from your pocket or from your father's pocket or from the bank? Does it make any difference on the business performance? No, right? The business will still run as the same. The money where it comes from, it doesn't make any difference. You may have your own money, you may have borrowed money from the bank, you may have borrowed money from your father, which is not interest, right? Or you may have borrowed money from a microfinance company which is charging you like 3%, 4% per month. But the ultimate objective is you are putting the money into the business, and for business performance there is no difference where the money is coming from. The business will run it as it is own, right? Correct. So the operating means how does the business perform. So you may have money on loan, or you may have money of your own on your own. So the operating income will tell you the real business operating performance, not the net income. Net income is only for owners. Operating income is mostly for business. So you may think now, if you are a startup and you have borrowed money from somebody, and somebody else now come and buy your business out. If you base your valuations on net income, because you are running business on the interest, your valuations from your perspective are very low, right? Because you are not operating the business. You are making valuation from your own income point of view. But if somebody else who has his own money, he don't need to pay the interest. For him, the income will be more, correct? So immediately the valuation will jump. Okay, so valuation part is the last class, so we will not go into it now. Okay, this is a part of balance sheet, an example of balance sheet. How does a normal balance sheet looks like? So you can see here you have assets, non-long-term assets and long-term assets. So long-term assets means which one you are going to use for more than 1 year. So all the definition of long term is more than 1 year, and you will see there is something called depreciation here. So depreciation means you are charging the value of assets over the life of your assets. So if let's say you have an asset for 3 years, so for example a laptop, how long it's gonna last for? 3 years, maybe 5 years maximum, right? After that it's become obsolete. So if I spend 1,000 now, and I'm not charging to this profit and loss account because I'm putting it in my asset. Whatever I define as an asset, it's not going to be charged into profit and loss statement, not as my expense. But I still pay the money, right? I still need to recover this money in 5 years. So what I'm going to do is I will divide the value of this laptop by 5, in each year, and I will charge one portion to the profit and loss every year. Divide by 5. If life is 5 years, if life is 10 years, divide by 10 and charge every year. So that charge is called depreciation. So why do we charge depreciation? To show the profit in equal terms in real life. So if the value is going to be charged for 10 years, we charge 10 years. If this is going to be used for 5 years, we charge in 5 years, equal installments. And also to keep a reserve. If let's say you are a business and you make $1,000 every year, but you need to pay depreciation, you are not paying depreciation, right? You are just making a charge to the profit and loss. After 5 years, you need to replace the asset. So where are you going to get the money from? If you are the owner and you see the whole profit, you will take everything as a dividend, correct? You will take out the money. Oh, I am earning a lot, so let's take out the money in cash. After 5 years, you have no money left to replace the assets because you already finished. You already spent all your money, right? So to keep a reserve of cash so that you can replace your assets in future. So it's like creating a fund slowly to replace the assets in future. So this is very important for a business which is very heavy on assets. If it's a startup which does not have a lot of assets, it doesn't really matter a lot. But if it's a factory building which is depend on assets, it need to build a reserve slowly so that after a certain point of time, when you need to replace the asset, you have money. If you don't have money, your business will shut down after 10 years, right? Okay. This is another statement. Normally, so here is you have assets, long-term assets. Non-long-term assets means the asset which are going to be finished in less than 1 year. So if something is less than 1 year, cash, is it gonna last for more than 1 year? No, because you need it tomorrow, right, to spend. In receivables, are you going to not collect the money for more than 1 year from your customers? No, you want money immediately, right? Or within 30 days or 45 days, whatever is your credit period. Inventories or your material, you want to sell as soon as possible, right? You are not going to keep that for more than a year. So that is all non-long-term assets. We call them non-long-term because our intention is not to keep for more than 1 year. Our intention is sell it out. If it doesn't sell, it does not change the definition here because it depends on our intention. If our intention is that we don't want to sell the inventory for more than a year, then okay, it's moved to long-term assets because you don't want to sell. Okay, liabilities work the same way. Now long-term means whatever you need to pay after 1 year, and non-current liability means whatever you need to pay within a year. Owner's equity means what money you bring in and whatever profit you have been earning during the life of your business. So the statement of owner's equity show you the reconciliation. What was your equity at the beginning of the year? How much money you earned? How much money you paid in dividends? And what is the left? What is the balance? Okay. And finally, cash flow. So cash flow is another more important document of any business. So what does cash flow do? It has three, as you can see, three segments. One is cash from your operations, cash from investing, and cash from financing. So cash from operations means your business operations, buying, selling, right? So how much money are you able to make from your normal operations? The cash from investing means how you are using the money. Investing normally will be in negative because you always are investing into the business, right? You always buy some new asset, you always buy new equipments to continue your business. So it will tell you where the money is coming from. The financing can be plus, can be minus. It means if you are taking a loan or you are repaying a loan, or you are buying a new equity share or selling your existing equity shares. So financing means it can be plus or minus. So how does it look like is whatever you have investing. So in this case, you are investing $115,000. So where this $115,000 come from? If business is investing $115,000, where the money is coming from? If you look at the statement, the money come from? The money, some money come from operations, right? 33,000, and the balance come from financing. In financing, what did they do? They are acquiring a new loan, right? 105,000, and they repay some short-term loan and dividends, correct? So means this is how they are using. So, but primarily they took a loan to buy a new asset. Some of the money come from their operations. So this statement will give you a snapshot of the company's overall performance in one single page. How much money is it? The money is able to, is it the company is able to make money or not? Is it, how does the company is spending its money? Is it investing enough or not? So what is more important here? Cash from operations. So if let's say you have a negative cash from operations, means you are not earning enough. Is it good or bad? It's actually very, very bad. So means if it's minus, what does it mean? You have no money to invest, correct? And where the money come from? Borrowing, right? Otherwise the balance will be zero, and cash cannot be negative, as we said earlier, right? So if you are losing money from your operations, where the money will come from? The money will come from borrowing. So which is not a good idea for a business. You cannot run a business successfully for a very long period of time only with the borrowing, or only by raising the money from investors, correct? So means issuing the share capital. That is not a long-term strategy. So if normally the investor or anybody who is investing the money to the business, they will look at the cash flow statement for last 3 to 5 years and see what is the trend. Is it the company being able to generate cash from operations or not? If company is able to generate the cash from their operations, it's okay. They may invest the money. But if you are not able to generate the cash from your operations, it's going to be very, very difficult to project that the company will survive for another 3 years, 5 years or not. Because whatever money they have been giving, you are losing in operations, right? Okay, so that is cash flow statement. So these are the 4 statements. 3 of them are very important. So what are the important ones now? What are the three financial statements we learned? First is the profit and loss statement. So what profit and loss statement tells you? Your income and your expenses. The second is balance sheet. So what does balance sheet tell? Your assets and your liabilities. And the third statement is cash flow. So what does cash flow tell? Where the money is coming from and how you are spending the money. So profit and loss will not be able to tell you where the money is come from. It will just tell you how much did you earn and how you spent. But it doesn't give you the assets, your investment, right? Or where the money is coming from if you are making a loss. Cash flow is telling you both the story. So cash flow, you can say, is a summary of your balance sheet and your profit and loss statement. So if you are not able to get profit and loss statement or the balance sheet, it's okay. So far as you understand the cash flow, that is the main document. You may be making a lot of income. What if you are not collecting it in cash? Maybe you are making a lot of sale. But what if your customers are not paying you? Correct? So what will be happen to your cash from operations? It will be positive or negative? Process, to summarize, start from writing the journal book, coming to the journal ledger, then go to the trial balance, and trial balance is divided into income statement, balance sheet and owner's equity. Cash flow is generated by these 2 documents together. Okay, so cash means whatever income you have earned, whatever expenses you have earned, the balance sheet will tell, are we able to collect the money from our suppliers or not? Are we collecting the money from our customers? Are we paying to our suppliers or not? Okay, so this is the summary accounting process. Now the next thing is before how we do the classification. Okay, you have recorded the journal, and you learn that we have to make the general ledgers, correct? And so, but how you will know which account will go to profit and loss, which account will go to balance sheet, and which account, what are the revenue and expenses. So we normally categorize our accounts into two parts. One is performance account and one is position account. So performance accounts means our revenues and our expenses. They show our performance. How much money we earn, how much money we spend, performance. Then we have position accounts. They will tell you your exact current position. How much money you owe, how much money you own. Means what is the total value of your assets. So most are asset and liability. So we divide all the category, all the accounts in these four categories. One is performance, revenue, expenses, and your position, assets and liabilities and equity. Okay. On the very major difference between these two is this expense will finish at the end of the year. Means if whatever you accumulate, it will not carry over to the next. If you have made a sale of 100,000 this year, when you next year you start the sale account, the counter will set to 0. Means you will always start with 1. So where this 100,000 will go? Sale will go to profit and loss, right? And profit and loss, whatever is the balance, will go to balance sheet. So it means this $100,000 will ultimately go to the balance sheet within the same year. And balance sheet means your position account are not reset. So if you have a total asset of 100,000 this year, next year when you start, you will start from 100,000. If you buy another, it will be on extra from 100,000, on top of 100,000, not 0. Sales and expenses will start at 0 every year. Every month, if you are, let's say, closing every monthly statement, every month it's 0, start at 0. If you are setting off your financial statements quarterly, it will start at 0 every year, every quarter. Every year it will start at 0. So performance accounts will always reset at 0, and performance account will position account will continue from where they were previous year. Okay. And performance account at the end, finally the balance of all the performance account in the form of profit and loss statement will go to balance sheet, owner's equity. Okay. Remember the first accounting equation we did, extended accounting equation we did. Owner's equity is part of your original capital plus whatever you retain from your income statements. Okay. So here is an example. So trial balance will go into 4 parts. One is your assets, your liabilities, your revenue, and your expenses. The revenue and expenses ultimately will, at the end of the year, will go to equity. So finally, at the end of the year, we will have only 2 things, either assets or liabilities plus equity. That's it. And that will continue to the next year not from 0, from where we left off. Okay. So these are some examples. So you need to classify which one is performance, which one is position. So what is revenue? Performance or position? Performance. Dividends?
Position.
How many say performance, how many say position? It is performance. Receivable? No. Position. Receivables means we are telling you, you don't do like a guessing, no, that either 0 or 1. Receivable means it will tell you how much money you need to receive. So it's not your income or expense, it's your asset. So it's a position account. Long-term assets? Position. Interest income?
Performance.
Performance. Additional paid in capital is position, because the paid in capital will stay there, right? Common stock? Position. Interest paid. Performance. Cash. Huh? Cash. Cash is your position account. Advertising. Performance. Tax payable. Position. Office supplies. Yeah, office supplies you can say either, because this one is not very clear. Office supplies you can have a performance account or you can have a position account. Depends on your policy. If you put this as an inventory, it will become your position account. If you charge immediately, it will go as a performance account. Rent. Performance. Inventory. Position. Suppliers. Position account. Yes. So these are the four categories that we discussed earlier. Assets are long-term assets, cash, inventory, receivables. These are position account. Liabilities, common stock, dividends, supplier, additional paid-in capital, tax payable is all position accounts. Then you have revenue and expenses. So these are your performance accounts. So performance accounts will go at the end of the year, we will merge them together and put into common stock as a owner's equity. So becomes a position account at the end of the year. Okay. Certain transactions which companies does with outside people's external, right? Most of the transactions are external because you have to have a third party to do the transaction. You are hiring a staff is also external, because from company perspective, who is the company? Is the owners, right? So owners, unless they are, even the owners, physical owners are separate from the company. Normally companies are like a legal entity, separate from their own entity, right? From their owner's entity is different. Staff is different, third party. All are third party for the company. So most of the transaction happen between two parties, one from company and external. So it can be your customers, your suppliers, your clients, lenders, shareholders, because it's easy to see what is coming in, what is going out, correct? Because we are either getting services or giving services, either giving cash or getting cash, right? But there are certain transactions which happen within the company where the third party is not involved. So what are those transactions? Nothing is coming in, nothing is going out, but we still have to record a transaction. We just discussed one such transaction in the form of depreciation. Is it a depreciation is external transaction or internal transaction? Is anything going out when you charge a depreciation? Nothing goes out, right? Because you bought an asset, but that was another transaction. Now you are charging the depreciation into 3 years, 5 years, different years. So that's not an external transaction. Nothing is going out, nothing is coming in, but it is still a transaction, correct? So there are certain transactions where nothing goes out, nothing comes in, but these are transactions within the company. So special transactions. Okay, only few transactions there are, not many. Depreciation, it's an internal transaction. So how it happens is it hit two places. One is your profit and loss statement in the form of depreciation, and another way is it hits your balance sheet in the form of reducing the value of your asset. Whenever you are charging the depreciation, it reduces the value of your asset. So if your asset was for 5 years and you charge 1 year depreciation, next year it remain only 4 years, right? Value will be reduced from 5,000 to 4,000. Another 1 year pass, the value reduced from 4,000 to 3. Another year pass, 2. Another year pass, 1. Next year, no. Zero value. So then in the 6th year, there is no depreciation charge because the value is already finished. Correct?
But is there like a standard for, let's say, if a company buys a car?
Yes.
Is there like a depreciation percentage? Right?
Yeah, normally every country has their own depreciation policy. Company can have their own depreciation policy. So depreciation, because the tax is like a subjective matter, right? The government, if you, let's say you want to charge, you say the life of this asset is only 5 years. Let's say you buy a Mercedes tomorrow and you tell the government, because depreciation you can deduct from your taxable income, correct? So you can say now the Mercedes is only 5-year life. Nobody will believe that, correct? But you can claim because you are the owner of the company, you are owner of the Mercedes. So let's say the Mercedes cost you $1 million. So now in 5 years, you're gonna charge how much? 1 year. 1 million divided by 5 is $200,000, right? 200,000 you will charge to profit and loss statement every year, and you submit to the tax department and say, okay, my total income is 200,000, and here is 200,000 depreciation. I earn nothing, zero. So I don't pay any tax. But government don't accept your 5-year policy because they think Mercedes can go as long as 10 years easily, right? What does that mean now? For government, what is your tax? What is your depreciation?
It's gonna be
100,000, right? Now your income remains the same, 200. 200 divided by minus 100,000. So you still have 100,000 balance, right? So you need to pay tax from government perspective. From your perspective, you don't need to pay anything. So there are policies, standard depreciation policy, which government follows to make sure you are not cheating with the tax. So they will not allow you. You can, in your books of account, you can do whatever you want. But when you are submitting the tax, you have to follow government rules. So government has a standard normally all around the world. Most of the time, they have a standard depreciation of 5 years. For something like office equipments, chair, table, car. For transportation equipments, car, truck, bus, they follow around 10 to 15 years. It depends between the country. In Europe, it's longer because their life are longer. In Asia, it's shorter because the roads are not very good. So the car will get damaged very fast, right? And also it depends on how you use it. If you are using it like as a taxi, so your car will go off very fast. But if you are using it for your for your personal use, you are not using the car that much, right? You may be using it once in the morning, once in the afternoon, once maybe go for a meeting inside. But taxi is all around, right? So the engine will go very fast. So it depends on how you use the asset. So depreciation is very subjective policy. So governments normally want to control. They will not allow your creativity in depreciation because it affects the tax calculations. So you need to follow government regulation when you are submitting the tax. But for your own books of account, you are free to do whatever you want to do. It's your books of account, right? So we have a very small topic to explain how the depreciation policy makes an impact on your books of accounts. Okay.
What's the policy here?
Where? In here, I think the cars normally they allow 10 years minimum. Means you want to use 15 years as a depreciation, they will allow, but minimum is 10. They prescribe minimum years. For example, like building which is made by concrete, they say minimum 40 years.
40 years.
Yeah, minimum. You want to charge 80 years, go ahead. But the longer life you assume, the lower depreciation you charge, the higher tax you pay. But you can use it for longer period of time. So it depends on the policy that you adopt. But government they have a fixed formula for allowing you the depreciation. You have to follow them. You have no choice. There was a company nowadays, especially now, the revenue department is very strict with the depreciation policy of the companies. They find one company, I will not name the company, they find them nearly $1 million for cheating on the tax rates. They did not follow the government tax rates. So when the revenue department come for auditing, they found the tax rates are very high. And they follow the exact same tax rate as per government, and they find them nearly $1 million as a penalty. And the company has to pay now.
Like
on
all
tax.
in one.
All in one. So whatever you have saved in the past, you are paying now. Okay? Okay, so the depreciation accounting is pretty clear. I think we don't need to go into the too many details. So the other internal transactions called accruals means making an accrual for for your unpaid liabilities. So maybe you have a salary to pay, right? But you have not paid in cash yet. So you still need to record the liability as your expense and as your liability. So why we record accruals is because we want to, if let's say you are doing monthly accounting. So if this month's salary you didn't pay, you still have to record your expense because you already, you already accrue the expense. It just doesn't matter that you pay or you didn't pay, right? You need to record expenses in which month they happen, not when you actually pay them. Then the provisions also the same way. The difference between accrual and provision is accruals means the transaction has already happened. You already consumed the electricity bill, you already got the bill, you already consumed the salary, you already have it, but you have not paid for it. Provision means you may have a liability in the future, you may not have it. For example, staff retirement. So if let's say all of you are my employees and you're gonna retire at the 60, so do I have to wait for 60 years to pay you the retirement fund? At that time I may go bankrupt if I don't charge your cost now, right? And if I don't charge your cost now in this period that you are working this year, but I'm not charging anything for your retirement benefits in this year. So I don't want to hit my profit and loss after 60 years. So what I will do is, I will build up the provision every year for 60 years. And at the end of 60 year, when I need to pay the money, I will use that provision and pay the retirement fund. So in that way, I don't hit my profit and loss statement in 1 year, rather for 60 years of accumulation, correct? So that's how the provision works mostly. Then you have adjustments and write-off. So adjustment write-off means, let's say you have a customer who was supposed to pay you 1,000 and now is go bankrupt. He pay you 500 as full and final settlement. So what will happen with the 500? The balance 500. Write-off. So that is we call write-off. We charge that to profit and loss. It's your loss, right? You lost the value. So you charge that loss to profit and loss statement and say, I lost $500 because of somebody go bankrupt. So that is called write-off. So that is also an internal transaction. There is nothing going out, nothing coming in, right? So it's called internal transaction. So this transaction is also important for most of the businesses. You have to review your accounts receivable, customers who were supposed to pay you money, your inventories. Sometimes the inventory, let's say you buy a register with your company logo and you put into your inventories. Next year you change the logo. So now you cannot use the previous one anymore, right? So what will happen to the value? Zero, right? So but you still carry that value in your inventories. So what will happen? If you don't charge off, means you say that, okay, I lost this value, and you don't charge to the profit and loss statement, that value will continue in your inventory for a long period of time, even though you know it's not valuable anymore, right? So that is called adjustments and write-off. Whatever you lose because of bankruptcy, because of the change in the company policies, change in the design, change in the value, you are losing assets or you are losing your rights, which you previously recognized as income or as paid for, right? So that is called adjustment and write-off. So most of the companies, they don't do it because they don't know, but they should do. Every year so what I want you to do is, I want you to record the journal. We do it quickly. Okay, we spend maybe like 15 minutes on this exercise. So so first is owner's capital. So now I want you to write the journal manually in your papers. So how will you record the journal when the owner invests the money? Let's say owner invests the money in cash.
So
What is coming in?
debit,
No, what is coming in?
cash,
Cash is coming in, right? So what will happen to the transaction? Cash will be debited. So you write down the first leg is cash debit. Assume any number you want, maybe 1,000, 2,000, 5,000, whatever. And what will be the credit? Remember the rule, fourth rule, credit the liabilities. For business, owner's equity is a liability towards the owner, right? So because nothing is going out, actually, only cash is coming in, nothing is going out, right? So you cannot apply the rule 1 or 2. It's not an expense or income, so you cannot apply that one also. You will have to apply the fourth rule where say credit the liabilities. So this is a liability, right? Owner's equity is a liability towards to the business. So credit owner's equity. Owner's equity will be credit for whatever amount you want. Okay. Then you are creating a liability, means creating a debt. So it's same like taking a loan. So second transaction is take a loan. Maybe whatever amount you like, 1 million, 10 million, 1 billion. Just do your imagination. So let's say you take a bank from AIA Bank, bank loan. So now you record bank loan. So what will come in?
Cash.
Again, cash will come in, right? So say cash debit, whatever amount you want. Credit will be AIA Bank because you take loan from the AIA Bank, right? So you have a liability towards AIA Bank. So that will become credit. So whatever amount you want to write. So now you use this two money, right? You accumulate, I don't know how much money you accumulate. Whatever is your imagination. Then you need to buy an asset. So let's say you are buying a building from this asset. So now you make an entry for buying a building. So what is coming in?
Asset.
Asset is coming in. Building is coming in, right? You get a right to use the building. And what goes out?
Cash.
Cash goes out. So what will be the accounting entry? Building will be debit.
Debit. Cash.
Cash will be credit. So make it entry. But don't make more than your capital. Whatever you buy, whatever you initially invest and you take the loan, you can spend lower than that. Don't spend more because you don't have money, right? Then the third one is owners withdraw the business fund. Now owners say, oh, you have got a loan, right? So I can use the money for my own personal adventure. So they bring the money out from the business. So you can assume whatever you are maybe going to Disneyland or going to the anywhere, maybe 1,000 or 100. So you withdraw money. So what is happening now? What is going out?
Cash.
Cash going out. And what is coming in? Nothing. So what is happening now then?
Expense.
It's not an expense also because it's not the company's expense, right? The owners withdraw its liability. So what happens is his liability reduced, correct? If owner's equity was 100,000 and he withdraw 5,000, so how much you need to pay him now? 95, right? So his liability reduced. So the rule 4 says debit either asset or reducing the liabilities. If you are reducing the liability, it need to be debited. So owner's account will be debited. Or you can follow the rule number 3 where it says debit the receiver. Debit the receiver. So who is the receiver of that cash? Owner, right? So owner account will be debited, credit will be cash. So owner's account is reduced by 5,000 and cash also reduced by 5,000. Then you have income received. So maybe you can do any business. You are doing a sale of anything, consulting or whatever, rent or from the building that you own. So now you are receiving an income. So you can receive a cash and record the income. Okay. Income on credit. Now you are still getting an income but on credit. You are not getting the money. So means you are recording some or receivable, right? Receivable is your asset, or you can say who is receiving the income, who is receiving the services is your receiver. So debit the receiver, correct? So the person who is your customer will be debited, credit will be income. Then you have getting paid. So since you sell on credit, you need your money back, right? So you get your money back. So what will happen in this case? What do you get? You get cash. And what is credit then? Receiver, because he is the giver, right? So he is giving the money, the debtor is giving the money, so you can credit the receiver. Then you have an expense paid. or expense paid on credit will be simple, right? Buying an inventory will also be simple because inventory will be debited and what will be the credit? Buying an inventory means it's cash, correct? Use inventory to sell because you use the inventory. So inventory means you buy a pen. So you buy 10 pens and record as inventory. Now 2 of them are taken by the. So accounting policies. So the different our accounting record accounting transactions will differ as per our accounting policies. So the accounting policy from one organization to another organization can be different. So it doesn't mean the rule will change. So the accounting policies normally govern how much to recognize, when, how we value the assets, and how do we recognize. For example, depreciation. You can have a different policy of charging depreciation in 10 years for same car, depend on some other company who may charge for 5 years, or another company who may charge for 20 years. So accounting profit for all the 3 companies will be different. Irrespective their operational capacities and everything else remain the same, the net profit will be different, right? So to be able to compare between two different companies, you need to make sure that the accounting policy they follow is same. If they don't follow the same accounting policy, you will not be able to compare and 2 different companies. Or if let's say you change the company policy for this year, then you cannot compare previous year income and expense anymore because that will be different. So how it different accounting policies can be different in revenue recognition. So how you recognize your revenue. So there are different ways the companies can recognize their revenue. Let's say for example a hotel. Hotel normally charge you the service money, right? So the hotel, 2 different hotels can have different accounting policy. One hotel will say, okay, whatever is my income only, I will record. Let's say you you have a bill of $100, then the hotel will charge you 10% service money, right? And that becomes 110. And the government say there will be some $5 as a government tax. So total become 115. So the one hotel can say, okay, government tax we don't recognize as an income anyways because that we have to pay to the government, but service charge is we collect, so we will recognize 110 as our income. Another hotel can say, hey, the 10 is actually for the staff, that doesn't money doesn't belong to us, so means we will record only 100. So same operating performance, revenue will be different. Expense, when it comes to expense, the hotel which recorded income as service charge because they pay to the staff, they will record as an expense also. But the hotel which does not record the service charge as an income, they will not record any expense, correct? So it means a different revenue recognition. So profit will be the same, but revenue and expense are different. Take another example. Let's say you are buying and selling. So you buy anything from let's say again because laptop is in front of me, so naturally I use this. So let's say you buy from the market and sell to somebody else. So you have 2 choices. One is you record the full value. Let's say you buy this for 1,000 and you sell for 1,500. So you can record 1,500 as your sale, 1,000 as cost of sale. Another company on the other hand can say, hey, I don't want to record the whole. I want to record only my profit. Because I pay 1,000, I charge 1,500, 500 is my income. So I will record 500 as my sale. So the accounting policies can be different based on the how they structure the contract. If let's say you buy the laptop, keep in your pocket for a long period of time and then sell it, then it becomes your cost and sale. But if you are waiting for customer to tell you, okay, where you should buy, what kind of laptop, then you are going and buying, means you are not taking any risk, right? So in that case, you can recognize only the difference as your sale. So a revenue recognition, inventory valuation. Inventory is, your inventories can be valued differently. There are different valuation policies we're gonna learn in bit. And depreciation method, how we charge the depreciation. Fixed asset. we gonna recognize all our spending as fixed asset, or we gonna recognize only some as a fixed asset. So you may say, if I have spending anything above $100, that will be my asset. Anything I spend less than $100, that is my expense, no matter what is the life of the asset. So you can have a different policy. So the companies with different policy will show different accounting results, different profit results, right? So you need to understand your accounting policy and craft your own accounting policy as per your business requirements. If you want to focus on every single item as an asset, you can say, okay, no debit, no fixed, no floor limit for amount. Whatever we buy more than 1 year is going to be charged as an asset, even if it's $10 or $20, correct? But if you say, I don't want to focus on the small amount, anything I buy beyond $1,000 is going to be my asset. Anything below $1,000 is all expense. Doesn't matter what is the life of the asset, correct? So the companies they need to decide at the outset what is the policy they want to follow. But policy is something which is very important to decide in the beginning, because you cannot change it every year. The policies are not supposed to change every year. You can change it only once you are required to change materially impact. And whenever you change, the normally financial statements require a lot of disclosures, especially if you follow IFRS or any other recognized international accounting standards. Whenever you change a policy, you have to do a lot of disclosures. So that may be painful. So select your policy carefully. Okay. So we're gonna look at now some different policies, how they affect your business. Depreciation policy. So as we said, depreciation policy can cover few aspects. Means the life, the minimum criteria to recognize as an asset. So you can have some fixed amount. For example, like in hotels, we have a policy that normally a spoon you can use for more than 5 years, right? If it's a stainless steel spoon. So, but every spoon we are not going to recognize as an asset, because it does cost very less amount. So we have a policy that, okay, if anything is cost, unit price is cost less than $100, we will not touch it as an asset. We'll just charge it to the expense, because we don't want to stuck in into the spoons, forks, or the ladders. We don't want to recognize that. We just record that as operating expense. But we keep an inventory physically of all the items that we buy. Even a spoon, even a fork, we have record of every single thing. Whatever is coming out of the hotel or whatever is coming in the hotel. But we don't recognize as an asset. We immediately charge to the expense. But it depends on the size of the hotel. When I used to work for Shangri-La, the size of the hotel is very big. So we can afford $100. When I'm working here in Myanmar, the size of the hotel is very small. So I made a policy of $50, because otherwise everything will go charged as a expense. Nothing will be remaining the asset, right? Then you have estimated life of use. So it depends on how you use your asset and in which location you are situated at. The same value, same asset will have a different life in different conditions. For example, a water filter. If you are in Yangon, the water is very heavy, so filter will run out very fast. But if you are in a city where the water is clean, then the water filter will not damage so fast, right? So it depends on where you are and what are the intended use of asset. So the companies normally determine what are the life of their assets. Some companies, because they don't want to have a separate set of accounts, they follow government rates. Whatever is government prescribed, we will use. We don't want to have a different accounting policy. Like my current company, we follow government rules. We don't have our own accounting depreciation rates, because otherwise we have to have one for our set and one set for government. So which is not ideal to maintain, right? So we follow one. Then you have method of charging depreciation. So how you charge the depreciation? You have different methods of charging depreciation. One is straight line. Whatever you buy, you just divide by 5 and charge equal. Another method is, if let's say you say the initial year my business is very low, or let's say you buy a machine which can produce, let's say 10,000 units, and you know in the initial year I'm not going to use my production will not be very high because I just started up the business. Maybe I will use 1,000, correct? Second year I may produce 3,000. Fourth year I may produce 2,000. Fifth year I may produce the balance. So you are charging based on your estimated production. So based on production capacity. Okay, and then another method is called written down value method. Did I explain? Yeah. So written down value method means we will charge you based on a fixed percentage. Let's say we charge 20% depreciation every year, but on the balance. So if the start asset with the asset starts with 1,000, so first year depreciation will be 20, correct? What is the balance left? 100 minus 20 is 80. So the next year I will charge 20% of 80. So the next year depreciation will be 16, right? What is the balance? 18 minus 16 becomes whatever, and then 20% of that left over. So that is called written down value. So we are charging depreciation a fixed percentage. Here the depreciation is not fixed. In straight line method, every year depreciation is the same. In written down value, depreciation is not the same. It is the highest in the beginning and lowest at the end of the year, correct? It follows the certain rule that, okay, when the asset is new, is used most. When the asset get older, the efficiency of asset get reduced, right? You use less. The value is less. So you charge less. Or based on usage, if the life is fixed, let's say a car engine can be run for 100,000 kilometers. So it depends on how you intend to use it. If you intend to use every year same amount, then you charge exactly the same. If you have a different schedule, you can use different schedule, right? Depend on accounting policy of the company. So you can have a different set of policies, but you don't change it every year. Once you set, you have to follow it, and you have to follow for all the assets. You cannot say my building will be written down value and my laptop will be straight line. You cannot do that. You have to follow the same method for every asset that you have in the company. Okay, this is an example. So let's say there is a machine that makes shoes. Okay, so assuming the cost is $100,000 and the life is $10. Residual value is 10,000. What is residual value? Sorry, the spelling is wrong. But residual value, what is the meaning of residual value?
Depreciation.
No, means at the end of 10 years, what will be the value of this machine?
10,000.
Yes. What is the residual value? How much the value of life? How much will the value of machine after 10 years? So that is called residual value. So the production schedule is like this: 2,000, 3,000, 4,000. I just made it up. So now if we calculate the depreciation, so this is the depreciation as per how we calculate. Cost is 100,000 minus the residual value. You don't charge depreciation on residual value. And the most companies, they made mistakes on residual value. All the international accounting standards, they require us, the companies, to identify residual value for all assets. And the depreciation is charged only on the balance amount. So total value of construction minus residual value, the balance is 90,000. So you can charge depreciation on 90,000, not on 100,000. Okay, where the most of the companies they make mistakes is they don't recognize 10,000. They charge depreciation on whole 100,000 because it's very difficult to know what will be the value of machine after 10 years. But there will be certain value, right? Even though the laptop after 10 years is gonna go waste, you still can get maybe $10, maybe $20, or if you break down, the screen can get something, the hard disk can get something, right? So there is a value. It's not that there is zero value. There will be some value. So companies normally have to identify a value which they can get after the life of the asset, and then they reduce it. So the balance amount is 90,000. So as per straight line, you charge 9,000 each year. if you follow the usage is total is 30, usage is 2000, 3000, 4000, total is 36. So what you do is 90,000 divide by 36,500. For every single unit, how much is the value of asset? Then you multiply with the unit of asset every year. So here you are charging the depreciation as per the usage. Okay, and the written down value means, if let's say we assume 25% depreciation every year, so the written down value will be every year we charge 20 based on the reducing balance. So first year is 90,000 into 25%. First year we charge 22,000. The machine will be left with 67,000. Then we charge 25% of 16,000. Okay, and so at the end of the year we will be able to charge 84,000. In this case, the value will never be zero, because you will still have left something which you can charge. The only thing is, after a very long period of time, the depreciation will be negligible, maybe zero or $1 or $2 only, that's it. Okay, but it will never become zero. So this is how we charge depreciation. 3 different policies. Now you can say 3 different results, means 3 different accounting profits. Okay, so you have to choose your accounting policy based on how you feel the assets are used. If you feel the assets are used equally over the years, follow straight line. Straight line is the most simple method which you can use, because you just have to divide by a number and then use it, right? Most companies use straight line, and even the government prescribes straight line, because government prescribes straight line, that's why they use straight line. But you can use any method that you want. Now most of the normally the companies use straight line because it's very simple to use.
When would you use written down methods? When would you use written down methods?
Where would you use? When you see that the asset will be mostly used in the initial years, and after the initial years, the usefulness of the asset is very low. For example, like production machines. So production money, when you just bought the machine, it's most productive, it's very efficient, highly efficient, right? After that, the efficiency will start to slow down, and at some point of time the efficiency will be very low, or you need to spend more money to invest, correct, to keep the efficiency up. So if your depreciation is high in those years, then you have a problem. You can use written down value to charge more into the profit and loss in the initial year to save tax, but if the government allows it. If government does not allow written down value, there is no incentive, correct? The incentive of charging written down value is you are charging more expense in the initial years and less expense in the future years.
So if you're like a car dealership, would you go with the written down?
Car dealer. But what is the car dealer's asset?
The cars.
No.
So that's the inventory.
Yeah, that's another important point that you made up. In the difference between inventory and asset, it depends on your use. If you are buying a car for buying and selling only, then it becomes your inventory, not your asset.
So if you're rental, you will use written down method. Right?
Yes, because the cars will be highly producible in the initial years. First 2-3 years, the most productive. After that, the production will go down because the efficiency is very low, right? So you will not be able to use the car much. So you use written down value. Assets and depreciation are, you need to categorize your assets into fixtures, buildings, plants, because they all have different rights, different age, right? Buildings mostly will be longer years. Plant, which means you are using for your production facility, so maybe your generators, your machines, your other things. So, and fixture means the building fixtures. So you have to categorize your asset properly so that you can charge the cluster rate. So normally we are not charging the depreciation for each and every asset, single asset. We charge based on category. So if something we assume as our furniture, we will charge maybe, let's say, 5 years depreciation. If something we recognize as a plant, maybe it's a higher depreciation. If we consider something as a building, it's higher depreciation. So whatever it goes into that category, will automatically get attracted to that. But you are not defining the depreciation for each particular asset. Okay, and the minimum amount should be set to put into the register. Otherwise, every single thing you will put into your fixed asset. So every company need to have a fixed asset register. So what does the fixed asset register means? It's just a list of your assets, whatever you buy. Why is it important?
Another company value. Company, to calculate the company valuation.
Not really. It doesn't affect company value. You have your asset or you don't have your asset register. But assume if let's say your business is now 10 years older already, and you bought something 10 years ago, not now, and you don't have a list, and your business is in 10 locations, how will you know how much asset you should have and how much you actually have? What if somebody is stealing, right? Somebody, let's say Pandya is not recording the chairs. I come here to teach, I bring the chair with me. So if Pandya does not have a list of assets, they have no idea where the chair goes. Because they don't know their chair was there or not. They may know immediately, but after 2 days, 3 days, they have no idea, correct? And how will they measure? They cannot, right? So if I am able to skim it out, I will take the money, right? So your money is lost, but you have no idea where is it. So that companies need to have asset register to control their own assets. Because you are not there every year, right? Every place, especially when your business is a long business or have multiple locations. You have no idea. So you are not present at every location. You don't have CCTVs everywhere. Even CCTVs, people can bring CCTV together, right? So you will lose the assets. So every year, normally first task every company must do, which mostly in Myanmar especially, not even in Myanmar, in Thailand, in Indonesia, everywhere I worked especially in Southeast Asia, they don't make a fixed asset register. They don't register. Whatever you buy, they don't make an itemized list. And every year you're supposed to go and check, does it still exist or not? Now you take, this is owner's control, right? Now you take a scenario of an investor who is coming in from outside and you are telling him, I have a value of $1 million assets. How do you explain? So he will ask you, okay, give me a list. Can you give? You don't have. So you will make up the list of whatever you can see, correct? But if let's say half of the assets are already gone, stolen, so you cannot produce a complete list of assets, right? So the investor will not give you, will not trust you have 1 million or 2 million or 10 million. So it's very important to have a register of fixed assets, especially when your business is growing and you have a lot of locations, lot of assets, mixed use of assets. So it's very important to keep it. Otherwise, it's very difficult to justify in future. Even to the revenue departments. So for tax purposes, for investor purposes, for your own personal control purposes, you need to have a register. And every year, every 2 years, every 3 years, you have to go and check physically. Is it this still exists or not? If it does not exist anymore, stolen, broken, even like say most in the hotels what we normally face is the chairs are broken. The staff or the general manager, they say, okay, this is broken up. Throw it away, buy a new one. So you buy a new one, you will enter into the register. But the one that you throw, you don't enter. Means you don't take it out. So your inventory list, asset list continues to grow. And once after 4 years, you say, as per my register, I need to have 50 chairs. But I can see only 30. Where are the 20 gone? So they will say, it's broken. So where is the broken? Don't know. So that is normally happens with the businesses which does not maintain a fixed asset register. They experience loss of value immediately. Like if you do a valuation today, they will lose maybe 20% or 30% of their value immediately because they cannot explain where the assets are gone. Okay, and the components. So if let's say you are buying a very big asset which has a lot of components, so you may be losing, you may have a different components which has different life. So we need to recognize it differently. Because if let's say you are buying a water treatment plant, so water treatment plant has a chamber, have the motors, have the pipes, all are different value. Maybe the plant will maybe can survive for 2 years, 3 years, or 5 years. Piping maybe can survive for 10 years, right? Or the motor can survive for another 10 years. So you cannot charge all at the same way, all at the same life, different. So you need to cluster, understand how the component works, and then charge separately. Okay, and the register we just discussed. Okay. So normally how we identify which expense is going to be entitled fixed assets or what is going to be an expense. So there is a simple asset test, we call it asset test. When you see the future economic value is there by spending in more than one period of accounting. That is the accounting definition. If whatever you spend, if you see the value of this spending is going to be last for more than a year, it calls for fixed asset. But you may define by your own accounting policy based on your amount, how much you want to recognize as a fixed asset or you want to charge immediately as an expense. But the definition is there. Okay. Example, research and development. So if you, let's say you are developing a product which normally the startups or the technology companies are doing all the time, right? You are doing a research and development which whenever you are developing a new product. So how do you call it? This research gonna benefit you in future year, right? So you want to capitalize it, means make it a fixed asset or charge to the expense immediately. It depends on the company policy and the results of research. How likely the research is going to be successful. If let's say if the research is getting successful, then okay, you can say the research is going to be successful, I can charge future year. But if the research is not likely to be successful, then it's a expense, right? Immediate expense. So normally when the big companies, they do research and development, if new product, they normally start with expensing it out, but whenever they see the possibility is there that okay, it's gonna get something else, then they put it into a product development cost. So normally they recognize as a product development cost in the initial time without charging to the profit and loss statement. But as soon as they get near to the result, and if they are sure it's gonna go as a product development, if the product will be successful, they capitalize everything. If they see that the chances are very less now, then it goes as a expense. But here you are talking about judgment, which is not standard, right? Every company, even every executive can have different judgment. You change a CEO or change a general manager, their judgment will change, correct? Patents, trademark, license, you're gonna recognize as an asset or
Fixed asset.
fixed asset. Patents means you're gonna use, you pay today, but you're gonna use it tomorrow, right? So you're gonna recognize as a fixed asset most of the time. Database, consumer list. Let's say you spend $10,000 on a Facebook ad to generate a customer list. Will you recognize as a fixed asset or as a expense, advertising expense?
Maybe depends on the outcome.
No, you will get a customer list. Let's say you spend $10,000 on a Facebook ad, which can generate you a customer base of 10,000 customers. For startups or businesses, nowadays customer list is a very important tool, right? Because you can generate a lot of business by those customers. So you're gonna use this as a fixed asset or as a expense, as an advertising expense. Highly subjective, right? You can do both. Actually, it depends on the startup. If let's say they put as an expense, their profit and loss will hit, right, immediately, so their value will go down. But if they put as an asset, this asset is maybe valued by another company as equally valued or not, it depends. right? If you don't put into fit P&L, you have to pay a higher tax if you are profitable. If you're not profitable, doesn't matter. If you're not profitable, it's better to put into asset, because at least you are building the asset value, right? But that's what most of the companies nowadays do. Like big companies, uh, Uber or other companies, they spend a lot of money on promotions to build a customer database, and they call it not as advertising expense. They call it mostly that, okay, some companies call it advertising expense. Revenue department come and say this is not capital, this is not advertising expense, because you are going to get the benefit of this customer in the future. So for me, it's a capital expense. Put it into capital and pay the tax. And the companies want to say this is my advertising. But some companies who want to show a profit, they will show this is my capital expense because the benefit will be in the future. Now this is the balance of my profit. So if you want to stay profitable, put it into fixed assets. If you want to save the tax, put into expense. I'm not telling you what to do. It's your judgment. Okay, but there are risks everywhere. The revenue department can take different judgments. Source code. If let's say you buy a source code from somebody, that's also a fixed asset, right? Because you're going to use that for your product development. So source code can be expense or can be depending on how you want to use it. Okay, so that is on the assets and depreciation. Then, okay, use in production of goods and services. So it's used in actual production for selling. So it can be a raw material for your product. It can be in progress, means something is in the progress, or it can be finished goods, unsold finished goods. So you can categorize normally in three parts: the raw material which is not yet processed, products which are in development, and finished goods. Does service companies have fixed assets? If let's say you are selling a consulting assignment, you are doing a consulting, do you have inventory? What if you have a project which lasts for 6 months and you just got the product and maybe it's in the middle at the time of closing the financial statements? You have spent only 3 months. You finish only 3 months, but the service is not complete yet. So you will not get the money from the customer, right? But you spend 3 months salary on your staff. So what will that happen? You will recognize the income next year, right? When you complete a project. But you recognize the expense today for 3 months. So how you want to deal with it? Then 3 months expense is here, 3 months expense in the future, but 6 months of income in the future, right? So means you want to recognize this 3 months as inventory. Means as maybe a cost of unsold services and put into next year profit and loss statement. Otherwise this year profit and loss statement is hit. Correct? So service industries can have unfinished projects which you have been working on it but are not finished yet. So you don't have income recognition, but you have expense already. So you need to put that expense in the income in the year when you are servicing the income, or the research work which you are doing for future projects. So that also can be recognized as inventory, but it's highly depend on the company's policy. Okay, these are just examples. So you can have different policies, but you need to have a policy. Because you need to have whatever policy you want to follow. You want to put into asset, you want to put into inventory, you want to put into an expense immediately, but you need to have a policy. But that why so that you can follow it year on year, and you can explain whenever somebody asks what is this. So then you can explain how I am doing it, and it depends on your objective and your individual condition. Do you want to stay profitable? If you want to stay profitable, don't show it as an expense, right? Put into either expense or put into inventory. If you don't worry about the profitability, then you can decide however you want it. Okay? So the costing is another policy matter of inventory, means how you value the inventory. So what are the different values? Do you know? Have you heard of it? First in, first out. What is first in, first out? First in and first out. So if let's say you buy 2 apple, the first apple you buy at $10. Now next day and you are not able to sell it. In the market next day the price of apple go up to $12. Now you buy another apple also, right? Because you just want to buy. So now you have 2 apple. One costs $10, another costs $12. On third day you sell 1 apple. You don't know which one, because you don't mark. Because it's the same apple, doesn't matter which you buy it for $10 or $12, right? Now you sell for 13. So how much profit you make? 3 or 2, 3 or 1, because you buy for 12 also, you buy for 10, correct? So how much is your profit? Depend on your accounting policy, right? How you value your inventory. So first in, first out means I bought one, the latest at $10, right? So that will go out first. So means my profit will be 3. But if I have another policy called last in, first out, means the latest one I bought will go first. So what will be the profit now? 13 minus 12, 1. So same process, everything remain the same. The sale remain the same, purchase remain the same. The value is different. The profit is different. Correct? So you need to make an accounting policy. So accounting policy will affect your profitability. Another method is called weighted average. So now I bought 1 apple at 10, 1 apple at 12. So what is the average cost? 11. 10 plus 12 divided by 2. So each apple cost me 11 now. So whenever I am selling at 13, I will make $2 profit, right? So which one is more preferable method?
First in, first out.
Well, first in, first out, yes, but then in that case you are showing a very high, if let's say the price are increasing of raw material, you show higher profit in the current, right? But low profit in the future years because the cost is not adjusted out yet. If the price are decreasing, your profit in the initial month will be low, in the future month will be higher, right? And also, so what is the better way? For me, the most easier way is weighted average. Whatever you bought, you just weighted average, you just continue to adjust the average, especially when the item is not identifiable. Let's say you are buying apples, you cannot differentiate, right? But you can differentiate in other, let's say you buy laptop also the same. But if you buy something which can be differentiated by when you buy it, then you can specifically use first in, first out or last in, first out. Depends on you. But if the items are not differentiable, then you have to use weighted average. You don't have a choice, because otherwise you cannot follow the correct policy. Okay, the weighted average cost takes care of your average cost, and so the profitability will remain the same over a period of time. Otherwise it will fluctuate and is very difficult to explain. Okay. So normally nowadays the most of the companies follow weighted average. And the valuation, that was only how you charge inventory. But how about the valuation? So valuation normally is done at cost or net realizable value, whatever is low. So if you bought at 10, now the market price is only 8. So if you want to go and sell in the market, you can get only $8. But actually you bought at 10. So your inventory will be valued at 10 or 8? 8, because that is the net realizable value. Okay, the net realizable value minus the cost of sale. If you have to sell, if you have to go to the market, spend another $1 to sell it. So the net realizable value is 8 minus 1, not 8 anymore. So the 7. So the value of your inventory is only 7, because that is what you can realize. Okay. So obsolete inventory. What is obsolete inventory? The inventory which is not usable anymore. Maybe my apple is rotten already, correct? So means we have to continue to look at our inventory every month or every year and see, is it still worthwhile or not? If it's not, we have to charge it off. Okay. The control point in inventory are monthly inventory taking. You have to take in monthly and do the valuations all the time. Okay, because especially for inventory, the value can change. The market prices can change, right? Even for fixed assets or for your purchasing cost, for your selling cost, raw material, whatever, and match with the inventory records. When you take the monthly inventory, same as fixed asset, you have to make sure nothing is stolen by the customers or by the employees. Okay, and then also identify the consumption. Means, let's say you have 10 in the beginning, right? 2 you sell, so the balance should be 10, balance should be 8, but and physically is okay, but your sale record is showing only 1, but actually you deducted 2, correct? So where is the difference then? Where the one go? Maybe the staff eat it, correct? So means you need to match your minus consumption with your actual sales record, which is normally happens in especially the consumer graphics. Like for example, in hotels, we make, because we cannot control the chef, right? He can eat while cooking, correct? No, we cannot control him, right? We buy him maybe 10 T-bones, but we are selling only 8. The balance of the 2 is eaten by the chef in the kitchen, and we don't have a CCTV, so we don't know. The only way we can know is we check how much he consumed and what did we sell. If there is a difference, means he consumed it or he wasted it. Maybe he not eat, but while making, he make a spoilage, or he was not tasty enough, so he throw it to the dustbin. But for company, we pay for 10 and we get income for 8, which is not a good idea, right? So even though the staff may be honest, but they may be inefficient. So it will help you to understand is there any inefficiency or not. But for that, you need to maintain a lot of records. Okay, and then identify what are going to be obsolete or slow moving items. Okay, then normal. Nowadays, especially for the startups which are selling bundled items, so normally you will say, okay, now you maybe buy a subscription, lifetime subscription on a website, right? Lifetime subscription means you pay now $100 for lifetime access, but the company has to do a lifetime service, right? They have to maintain the website, they have to maintain the servers. So does it mean they earn 100 now already or not? No, right? They didn't earn 100 yet because they had to do the service in the future. So normally the companies now, especially with the new IFRS, there is a new accounting standard. Previously, before this, the company was recording $100 as a revenue today, but the cost will continue to come in the future years. So revenue is here, the expense is in the future years. So you're not matching the revenue and expense, correct? So the new accounting standard requires company to split the revenue into current revenue and future promises. So you have to estimate how much money you have to pay for future. If let's say all 100, mostly maybe only 50 is for this year. The rest of the 50 you need to pay for future. So you can recognize 50 as this year income. The balance of 50 will go in future to offset the expenses in the future. You buy a car, the company give you 3-year guarantee, correct? But they don't charge you anything, right? So this guarantee is bundled into the car price, correct? So company may charge you $100,000, but they are saying, okay, 90,000 is for car value, another 10,000 is the guarantee, 3 years guarantee or 4 years guarantee, which is free of cost. For that, company need to pay after 3 years, up to 3 years, right? They still need to have a staff, they still need to have maybe somebody, if let's say your car is actually damaged, they still need to pay for it, correct? So nowadays companies cannot recognize revenue upfront, that today we receive 100,000, so we receive 100,000, no. You have to split the revenue for future obligations, whatever you have to spend in future. Okay, so normally the equipment can have like, let's say for example you are buying an equipment, so you may have an equipment, you have an installation cost, you have post-sale services, and you have material rights. So let's say you charge a contract price 40,000. The rest is all free. Installation is free, service is free, or there are some other benefits which are given out as a free. So previously before this, the company need to recognize 40,000 as income. The rest all go as a cost because it's free. Correct? Now after the new accounting standard, companies are required to split the revenue into 19,000 for equipment, 10,000, 11,000 for installation, 4,800 for sales services, and 4,000 for other freebies. So the revenue is recognized when the items are either delivered or installed, or when the actual future sales service is done, or when the company the person has claimed for the freebie discounts. So the company need to split our revenue into multiple parts. So we will not go into this detail, it's going to be very complicated for you. The last thing is in revenue is segmentation. So as I said, segmentation means understanding where your revenue come from. Who are your customers? So how we segment the revenue? Based how we segment the customers. Is there any criteria?
The amount of frequency they buy and the amount of money they spend.
Amount of?
Money they spend on the product or service that we provide.
Yeah, you can say it like a paying capacity. So one customer may be a businessman. For example, I give you an example of hotel. Okay, there are many customers who go on internet and buy. Means they are paying a full price, right? There are customers who don't want to go internet and buy. They want to go to a travel agent and pay. So do you know the travel agent will pay the hotel maybe 20% or 30% of whatever you pay. So we give the margin of 30% to the travel agent. But he will not sell you cheaper than the online rate. But for us as a hotel, if you book directly, we get $100. If you book the same room via travel agent, we get only 60 or 70. If you are a company, we are not selling at the online rate. We are selling at a different rate. Have a contract rate, right? If you buy 10 rooms in a bulk, you are paying us much lesser than if you pay individually, right? So for us, you are a different customer. So we want to understand how our business coming from. Our business coming directly, our business coming from travel agents, our business coming from the contract staff, or our business coming in the groups. So the revenue segmentation is normally done on the customer in the way of how we approach them, how do we market, so or how they book us, how they come to us. They can come us directly, they can come to us indirectly via travel agents, via corporate companies, via other companies, right? And the value proposition expected. So means one customer maybe require a suite, and another customer may stay in a deluxe room. One customer may require business class in the aeroplane. One customer is happy with the economy, right? The one customer may buy a full service. If you buy a ticket, do you buy a ticket which is able to change the price or which is not able to change the price? Dates. If you buy a ticket online now and you search a ticket which is fixed dates, they will cost you very cheap because the dates are fixed. But if you want to buy a flexible ticket, you have to pay a higher amount, right? So they are two different, these are same person, same ticket, same plane, the different customers are two different because of their paying capacity. Somebody want to buy very cheap, somebody want to pay higher. So the person who want to sell cheap, company cannot have a different rates, right? They can have only one rate in the public. So they differentiate the rates by giving different options. Okay, if you want to buy cheaper, no problem, but you cannot change in the future. If you want to buy expensive, you can pay expensive, okay, pay full price, right? So it depends on the customer now and depends on their needs. So you can also segment your customers by charging different prices or offering different services, how they want to pay. So it depends on their willingness. So that's why we can say willingness to pay for goods and services. So these are the three criteria. But you don't need to have multiple segments. It doesn't mean that you will create 20 segments because you have 20 type of different customers. You need to categorize them to a maximum of maybe 5 to 6 segments maximum. Otherwise, you have 10, 20 different segments, means you need to have a 20 different focus on marketing and proposition, right? So which is not a good idea. So you need to keep your segments between 5 to 10 maximum, not more than that. Otherwise, it's too much details that your marketing team or yourself are not able to focus upon. Matching. So how you expense the match? The only thing is you need to match the expense when you are recognizing the income. Okay, that is the only important point in expense matching. Means whenever you are earning the income, you need to recognize related expense. You pay or you don't pay. Otherwise, you defer your revenue to actual expense whenever you need to make the expense. Okay. Okay, the rest is not really important. And you need to differentiate between your capital and operating expense and non-operating expense. Okay, operating expense and non-operating expense are, I explained to you previously, right? You can have different operating expense means to justify different models, different business model you're using. And non-operating expense are, if you don't separate, non-operating expense means your interest, your rental of the property where you are doing the business. It doesn't affect your business performance. You own the building or you rent the building. It's the same thing, right? But from an operating perspective, as a business, you need to know what is my operating profit so that you can compare with other businesses. So you need to understand what expenses are making an impact on business performance, not on your profitability. Profitability, yes. If you pay the rent for this building, you have to have a less income. But from an operational perspective, it doesn't matter you own the building or you rent the building, right? It's a different business model. So you have to understand what is operating expense for me, what is non-operating expense for me. So that you can understand, is your business making enough operating income or not? Okay. So large expenses does not mean that it's capital. Some people, they say, oh, I spent $100,000. Is a lot of amount to spend on profit and loss. But amount does not qualify for capital expenses. Intention and the usage. Okay. Yeah, not yet the last. Cost center. I also don't know what else I put it here. Okay. So cost center accounting means you need to identify your significant departments or significant contributors of revenue and match the revenue and expenses to each profit center. Okay, for example, maybe in a hotel, where the money come from? We sell rooms, we sell outlets, we have spa, we have transportation, right? So for us, every department is a separate department, separate profit center. So we want to understand the profitability of each and every one separately, so that we can shut down the one which is not profitable to maximize our business, right? In the beginning, I gave you an example of 10 different businesses. Maybe 2 are making loss, 8 are making profits. So you may want to do something with the one which are making loss, but you need to identify them first. So there will be some costs which are common. For example, one CEO is managing all the businesses. So how will you identify the business? Cannot, right? You cannot identify the time spent by the CEO on each and every business. You're not recording the timesheet. So there are certain costs which are common, like brand, building rent, CEO expense. But there are certain expenses which can be identified, like specific marketing expense, specific revenue, specific cost of sales. So at least if you know that, you will know the business or the profit center's operating capacity. Okay. Common expenses you cannot segregate. If you cannot segregate, just keep them together, which is not necessarily you have to put into. Otherwise, if let's say you say, okay, the CEO will be charged 1/10 in every business. In actually, if some business is very low income, even though he's making money, you will say this is not profitable anymore, because after charging the salary of CEO, this profit center does not make any money. So shut down that business, which is not correct. Without charging the common expenses, he's still making money, right? So it's contributing to the salary. So you need to understand that what are the fixed and common expense and what are the specific expenses to the business. Okay. Okay. Control aspects of AR means you need to have a credit approval system for your business. Businesses can make credit sales. So you need to know who are our customers and how we control. You are not giving credit to every single body, right? Not everybody who is going on the market can come and say, I will give me the money, give me the services today, we'll pay you tomorrow. Do you think that person will come back tomorrow? Maybe not, right? So you need to have a control system, credit approval system, on time billing and serialized. So the billing need to go on time and it need to have a serial number to make sure that even your own staff are not cheating. Maybe they give you maybe they sell something and they took the money in cash and pocket it. So as the owner you will not know, right? I have seen the cash collection controls, cash collection frauds. The company, the person who go out in the cash and collect the cash, he can mess up your cash collections. I have seen a fraud of up to like $2 million. Somebody who did a fraud of $2 million while only the cash collection. So he was not even the highest position staff in finance, where only the bill collector. He go and collect the money and doesn't report to the company because the company didn't give him the serialized controls and they don't ask him. And so how the money, because this customer is not paying, right? So how he does it? He take money from one customer and put into another one. Take money from this customer and say, okay, this person already collect. So whoever is overdue, he adjusts the first, but keep all the money with himself. So he's not reporting the money to the company. After a while, he spent all the money. So now the company lost $2 million. And finally, the provision for bad debt means once you review your customer, you need to understand who is going to pay us, who will not be able to pay. So you need to recognize your expense timely. Earlier you recognize is better for you, right? Okay, advances are similar, means normally we don't look at it. Once we pay the advance, normally you need to receive the services, right? But this is something which we normally don't do. We don't know how many advance we have given and have we received the services or not, because there is no register. There is no control on the aspect. So you need to have like an advance register where you are recording how much money you are paying in advance to whoever and have you received the services which they were supposed to give or not, and have it reviewed like every 3 months, every 6 months to make sure nothing is pending for a very long period of time. When I normally start any new job, I first go and check what are the pending advances being there. So normally what I find is, for 4 years we paid the advance to a certain company and we have not get the money, or we are not getting the services. So what does it mean? You pay the advance, the supplier go and you lost your money, right? So that normally happens in every business. Okay, then what is working capital? The money that you need for your day-to-day business, right? Maybe your daily or monthly cash requirements, amount that you need to make for purchasing the raw material. So you need a lot of money to run the business, right? So normally assessment you do based on either your cash flow, how much money you need to spend on a daily basis to survive the business, how much credit sale you need to do, how much supplier you can get on credit, what you can buy on credit, what you cannot buy on credit, right? And how much inventory you need to keep in your stock all the time. So that becomes your working capital. So you need to estimate and make sure you have it all the time. Okay. So normally you have a higher cash conversion cycle, means you normally buy a material until it's sold. It's called inventory days. And once you collect from the selling until you collect the money, is called receivable date. Total becomes operating cycle. Okay, but you don't need to pay for your inventory all the time. So that becomes payable days till the time you pay your suppliers. So the balance is called cash conversion cycle. So our objective in working capital management is to reduce this cash conversion cycle. So how you can reduce it? Either try to sell faster. If you're not able to sell faster, collect faster. If you are not able to collect faster, pay your suppliers late, right? If you pay your suppliers late, you can manage your cash conversion cycle to be the lowest. Otherwise, you have to, if you are payable, you are paying too fast, and you are collecting very late. You need a lot of money to survive in your business, right? Which is very difficult, especially for a new company or which does not have enough capital. Okay, so our objective is to minimize this cash conversion cycle. So you need to identify first where the cash conversion cycle can, what is the cash conversion cycle, what are components. Are we selling too late? Are we collecting too late, or we are paying too fast? So either you sell faster, you collect faster, and you pay late. Then your cash conversion cycle is reduced. You know what is the cash conversion cycle of Apple? Apple company. Apple, minus 60 days.
60 days.
Minus means because they sell very fast in advance mostly. They don't sell on credit. Okay, you have to pay the money in advance, but they pay their supplier after 90 days. So their cash conversion cycle is actually, they are actually getting finance from their suppliers. They don't do that. And sometimes company can have a cash conversion cycle up to like 90 days. Means sometimes they take a long time to sell. And if, for example, like Samsung has a higher cash conversion cycle. Why? Because Samsung made a lot of product. Their product sells slower than Apple, and they sell on credit also. They sell to the dealers, which pay them money later, and they pay their suppliers comparatively faster than Apple. So they have a positive cash conversion cycle, means they need money to run their business. While on the other hand, Apple, they don't need money to run their business. They run their business from the supplier money. So they get the material first, they pay them later. But whatever they sell, they can get the immediate cash. So our target is to have negative cash conversion cycle, or at least the lowest possible. Okay.
In our previous session, we saw how accountancy plays an important role in business and in decision making. But before moving on to learning the record keeping in detail, it will be easier if we understand the meaning of certain basic words or terminologies that are generally used in accountancy. In our previous session, we saw that Peter brought in $10,000 in his business. This money that is brought in by the owner into his business is known as capital. So Peter's capital is $10,000. And the person who brings in this capital, and in this case being the sole owner, is known as a proprietor. So Peter is the proprietor of his grocery store business. In this month of May, Peter went to a furniture mart and he purchased a chair and a table for his store for $2,500. The chair and table will help him in smooth functioning of his business. Such things are known as assets. Since this is an asset which will be used for long term in the business and is not meant for sale, it is called a fixed asset. Now, can you tell me what Peter's business involves? It involves buying and selling of groceries as the main activity, right? So this grocery will be called his goods. Goods are always purchased for resale. But goods can be different for different businesses. For Peter, furniture is an asset and grocery is his goods. But what if someone had a business in furniture? What will be his goods? In that case, furniture would be his goods. In the same way, for a person who owns a bookstore, goods will be books. When goods are bought, they are called purchases. And when goods are sold, they are called sales. Are we good so far? Let's move further. Peter went to a supplier and purchased goods worth $4,000. He paid the supplier $3,000 cash, and the remaining $1,000 he promised to pay within 45 days' time. The goods that were purchased in cash, where payment was immediate, are called cash purchases, whereas he took 45 days time to pay the remaining money. This is a credit purchase. This means that payment will be made at a future date. What do you understand from the word credit? It relates to some sort of a benefit, right? So the person who gives this benefit or allows a credit is called a creditor. Peter's supplier is a creditor. But Peter has received this benefit of time. This means he has to pay at a future date, which means he is in debt. He owes money to the supplier. Therefore, Peter is the debtor here because he is in debt. Peter then started selling grocery. Most customers paid him in cash. For Peter, these will be cash sales. A customer purchased goods and promised to pay in 1 month's time. These sales are his credit sales. Here the situation is reversed. So can you tell me who is giving the credit and who is in debt now? Here Peter is giving the credit, so he is the creditor. And his customers are in debt, so they are the debtors. Okay, let's move further. Now Peter had to pay his monthly rent and electricity bill for $500. These are recurring in nature, or you can say they are to be paid on a day-to-day or monthly basis. Such payments are known as expenses. Can you recollect what are assets, goods, and expense? Can you tell me the similarity or the difference between the three? In all the three cases, money is going out. But it's going out for three different purposes. Can you tell me what is the purpose? Assets, for functioning, not meant for sale. Goods, for resale. Expenses, for day-to-day or monthly activities. Now can you tell me the difference between a creditor and a debtor? The person who gives credit or benefit of time is a creditor, whereas the person who receives this credit of time and is in debt to pay on a future date is a debtor. All of this, purchasing, selling, paying expenses, anything where goods or services are exchanged for money or money's worth are called as transactions in accounting. When we maintain records, these different transactions are recorded under different heads, known as accounts or accounts head. For example, all cash transactions will be noted under a cash heading, called as a cash account. And all credit purchases with the suppliers will go under the creditor account. Let's go back and see all the different terms that we covered in this session. Thanks for watching. In our first session, we've seen the importance of record keeping and accountancy. My friend Peter is now aware of different terminologies that are used in accounting, which we have studied about in our second session. This is the third month of his business, and his grocery store business is now really going big. So Peter also needs to learn accounting in more detail to manage his business in a proper manner. So in this session, we are going to try to learn the basic accounting concepts or principles which help us to prepare our accounts in a more systematic manner. Now, accounting reports are kept by accountants all over the world for different businesses. There are many parties that need to know about your business or your company, like investors or creditors or shareholders, individuals who want to invest, banks who provide loans to them, government agencies who collect taxes, etc. This means accounting record of your business is just not meant for you. There are many more stakeholders or outside parties who need to read and understand your accounting records. Now suppose this person represents the outside parties. And if all the companies or businesses kept records differently, that means in different manners and different style, it would be very difficult for this person or other parties to understand these accounting reports. So, it would be much more easier if there were certain basic guidelines and rules as to how everyone should maintain their accounting reports, right? Now, so that there is uniformity in maintaining these records, there are certain concepts and guidelines that are known as Generally Accepted Accounting Principles or GAAP, which is universally accepted. Now, we will learn about these basic accounting principles as we come across what is happening in my friend Peter's business in this third month of operation. This month, Peter tried to maintain his own records. But when I checked it, I felt there was something wrong. Let's look at his report. He's recorded his rent, his salaries, his electricity. He's recorded his residence maintenance bill, and he's also recorded a washing machine purchase. Oh, residence maintenance bill? Is this supposed to be considered as a business expense? And this washing machine is for personal use, but he has recorded it as his assets in his business accounts. Well, these accounting treatments are wrong. It is not possible to find the correct state of affairs of his business if he mixed his personal expenses into his business. So all of his personal expenses or assets purchased do not form part of his business activities. Either he should have paid these expenses from his personal bank account, or he needs to show these payments as personal and account for it separately. Basically, all personal matters of the owner are totally separate from his business. This is a concept in accounting called as the entity concept, where the business is considered a separate entity from its owner. Entity means has a distinct identity. Now suppose Peter had two other businesses, say Peter's car repairs and XYZ bookstore. He would keep all of their records separate as well. Separate books of accounts for Peter's car repairs, separate books for XYZ bookstore, and separate books for his grocery store. So the entity concept states that a business is a separate entity from its owners. We see that the owners of businesses or companies change. We also see that ownership is passed on to their children or somebody else. But does the company or the business close down? No, the businesses or company still stays in its own place with their own distinct identity. In other words, death or insanity of the owner may not affect the continuation of his business. So business is independent from its owners. They are two separate entities. This was the entity concept. Let's see what happened next. Peter purchased a grocery weighing machine for $2,000, which is going to benefit his business for 10 years. So will he treat all of this $2,000 as his expense for current year? Well, any business needs to be treated as continuous because usually every business or company starts with the intention to stay in business for a very, very long period. Unless there's a specific event due to which it is mentioned that the business is going to last only for a definite period. So what is important here is this machine will be used for 10 years. And since we are going to assume that this business is going to be continued for a very long period, we do not have to record the entire amount as an expense in the current year. The entire cost for weighing machine needs to be split into 10 years. All of this $2,000 will not be treated as an expense in the year the asset was purchased. Only 1/10 part, that is the expired cost of the current year, will be treated as expense, that is $200, and the remaining $1,800 will be shown as an asset. As this weighing machine is an asset to the business, it's going to be used for a long period. Now, every year, the value of this asset will be reduced by 1/10, and then it will be shown under expenses. Here, we are believing or assuming or we are treating that our business is long-term or continuous, and that is the reason we will provide for the remaining expenses in future. So this assumption that the business is going to always be going on is known as the going concern concept. Concern here is nothing but the business. Let's take another example. Suppose Peter spends huge amounts on advertisement, say $6,000, but it will be beneficial for his business at least for 6 years. So only 1/6 of the entire amount, that is $1,000, will be shown as current year's expense, and the remaining $5,000 will be shown as assets, and it will be reduced 1/6 every year. Now, what if a business needs a long-term loan? Will the bank provide a long-term loan if it has been mentioned that the business will only last for a definite period in their records? Well, they may not provide the loan. But if a business is a going concern and has provided for payments in future and has a good reputation, only then will the bank provide a long-term loan. I hope you're getting me. So this was the going concern concept. You always assume that a business is going to be continuous or long-term. I hope you enjoyed this video. Please share it with those who can benefit from it. Thanks for watching. So this is the 4th month of operation of my friend Peter's business, that is July. In our previous session, we came across some principles in accounting like the entity concept and the going concern concept. So let us see what is going on in my friend Peter's business this month. Peter purchased goods worth $500. Now this is something he will record in his books as purchases. Then he sold some goods on credit to Ron. So he will record that Ron is his debtor and he has to receive $500 from him. But one of the days he was just thinking about how he started his business and how after a few months his business has improved. And he was feeling quite proud and happy. So, would he also record his happiness in his accounting books? No, happiness is something that cannot be valued in terms of money. So he will not record happiness. This is nothing but the money measurement concept of accounting, which states that only events that can be valued in terms of money can be recorded in accounting books. So death of a partner, happiness, sorrow, love, all these cannot be recorded in accounting books. After some time, Peter purchased an insurance policy for loss of goods from one of his friends who owns an insurance company. So he purchased this insurance for $2,000. But the actual market price to acquire this insurance policy is $3,500. So which amount will he record in his books? He can only record the price that he has paid to acquire this insurance, irrespective of what price is actually going on in the market. Peter also got some furniture from his father-in-law for $500. The actual price of this piece of furniture was $1,000. So at what price is he going to record this? He's going to record that he purchased furniture worth $500 and not $1,000. Now this month, Peter also purchased a mobile phone for $200 to take grocery orders on call. He is strictly going to use this mobile for his business use. But only in 2 days, the price of that mobile model dropped down to $120. So at what price will he record his asset purchased? He will record only that amount that he pays or is liable to pay, which is $200. So this is the cost concept, which states that transactions are recorded at cost price and not the market price. So that is all for today. We've covered the money measurement concept and the cost concept. Thanks for watching. Well, in the past few months, my friend Peter's business is going pretty well, and the records that he's keeping is helping him to keep a track of all his business activities, and due to that, he's also more confident, and it's also overall helping him to take decisions. Thus, it's helping his business to perform better. He has now learned that he must keep his business and personal expenses separate, and must always assume his business to be long-term or continuous. He also understands that he can only record the things which can be valued in terms of money and record any transaction on the actual price paid or what is liable to be paid and not on the market price. This is the 5th month of Peter's grocery business, that is August, and he has a little trouble understanding when he should write or record his transaction in accounting books, because the other day Mr. Y came to his grocery shop and said, "I need these 4 items, but I will come and buy them later." That day Peter was confused if he should record that in his accounting books. So what do you think? Can he record those 4 items as sold? Well, they haven't been sold yet. There isn't any guarantee that the customer will come to buy those goods. So when a sale is uncertain, Peter cannot record or recognize this as a sale in his accounting books. Either payment should be made or both the parties must legally agree on the transaction for it to be considered as confirmed. Now, the next day, the same customer comes and confirms this purchase. He signs a note that he is liable to pay $200 in 1 week's time, and he asks for the goods to be delivered. Here the price he agrees to pay, that is $200, was fixed on the day he confirmed his purchase. In this case, can the transaction be recorded? Yes. Here both the parties have agreed, means there is certainty that goods will be delivered and that $200 will be paid in 1 week's time. So Peter can record this transaction even though the actual cash has not been received. So this concept where you recognize or record sale of goods and services when transaction is certain or complete is known as the revenue recognition concept in accounting because it tells us when to recognize revenue. Okay, let's proceed further. Now, after a few days, Peter ordered some stationery items for $580 from an online website. He needed them for packaging of his grocery supplies. Here, the price is confirmed. He paid the order amount $580 through a debit card. The delivery of goods is promised to be made in less than 2 weeks' time. Now, in this case, stationery is an expense for Peter, but it is a revenue for the seller because he made money out of sales. So, will the seller recognize or record the sale of goods as revenue? Yes, because once payment is made, definitely a transaction is certain. So he can recognize this $580 as a sale in his accounting books. And Peter will simply record this as an expense. Now, here in all these cases, we were talking about the revenue, which means receipt from goods and services. And when exactly is this revenue supposed to be recognized or recorded or realized in accounting books? All these words mean the same thing. So, when can it be recognized? 1. When transaction is certain. 2. When either payment is received or is legally agreed upon, means it is recoverable. And 3. The goods may be delivered or agreed upon to be delivered. So these are the 3 things to keep in mind for the revenue recognition concept, also known as the realization concept. Now, Peter's doubts are cleared, and I hope it clarifies some of your doubts too. Moving on from this month there was a special visitor in Peter's grocery store, the auditor. Do you know who an auditor is? He is a qualified official and it is his duty to check on the accuracy of business records. He demanded that Peter showed all of his business records. But now, in order to verify the accuracy of Peter's records, he also needed some proper proof. Like, if we go and purchase an item from a store, we get a bill as a proof. The seller saves this copy of the bill to keep it as a proof of his sale. He uses all the proofs like receipts, invoices, payslips, bills, etc. to support his records. So these little written documents are called as vouchers in accounting. Peter too had saved all the vouchers and he had attached them to his records as proof. As sometimes, government agencies or auditors may come to keep a check on your records. So this is nothing but the concept of objective evidence, meaning we should have concrete or physical evidence or proof of all our records, and the records should be objective. That means it should be unbiased, non-influenced by personal judgments. It should not be mere imagination. So this was all in the month of August. Thank you. So these are the different principles of accounting that we've covered so far. If you have missed any of these, do click on the link and check them out. So we've been talking about how record keeping has been helpful for my friend Peter. He has been enthusiastic in learning accounting. There have been some problems that he has faced as to when to record transactions, and slowly he's understanding and improving himself. It is now the 6th month of his grocery store business. We are in the month of September. Let me tell you what happened a few days ago. So it was the end of a long day for Peter, and before closing down the store for the day, he was counting his cash. He counted he had $300 cash. He kept it back in his drawer and locked it. The next day, he made a sale of $800 cash. he only recorded his sales transaction, which was $800, in his sales account. But he forgot to record the same in his cash account. Later that night, when he checked his cash drawer, he had $1,100 cash. But the cash account in his accounting books was still showing $300 from yesterday's sale. This means without recording both these effects or dual effects in books of accounts, our records will be incomplete or imbalanced, and it will show a wrong status. In this case, there were two accounts affected, that is, the sales account and the cash account. So basically, if any transaction takes place, it affects two different accounts. Let's try to understand this concept. Let's say Peter sold goods on credit to Mr. Adam worth $300. This transaction results in impact on two matters. Can you tell me what are the two accounts that will be affected? The sales account will be affected as goods are sold for $300, and Adam's account will be affected by $300. So both these accounts are affected equally, that is by $300. All okay so far? Let's see what happened next. Oh, this month, Peter hired a new employee, Tom, for a temporary period to make sales in his grocery store, and he paid him $200 as salary. Now can you tell me the two accounts that will be affected? Yes. In this specific case, cash and salary are the two accounts which gets affected equally, that is by $200. So this concept that every transaction has an equal effect on two different accounts or dual accounts is called the dual aspect concept in accounting. If we record only one side of the transaction, means if we make a single entry, there will be a mismatch. Like we saw, Peter's cash account did not show the correct amount. That is why we follow the dual aspect concept, also known as the double entry system of accounting. The double entry system of accounting gives an accurate and complete record. Peter will know the correct status of his business, expenses, incomes, assets, and liabilities. Since all of our accounts is based on this dual aspect concept, we need to be very careful while identifying the two accounts that are affected. We will understand and learn more about this concept when we will learn how to make and maintain the different books of accounts in our upcoming sessions. So, moving on, this month Peter is planning to launch his own homemade pickle brand in the market. He paid $5,000 for an advertisement campaign, but this advertisement campaign will take place in the next accounting period. So the service that we will receive or the revenue that we will receive because of this advertisement campaign will reflect in next year. So we will not record the expense when incurred in this case. It will be matched with the year we will receive the service, or we can receive revenues related to it. This is nothing but the matching concern principle in accounting. This principle requires that you match revenues with the expenses incurred to earn those revenues, and that you report them both at the same time period. Now you might be wondering, what is the use of having this concept? Just imagine if we wrongly record high expenditures or incomes all shown in one accounting period, we may have high profits in one year, again losses in the other, again high profits in the third year. This means if the wrong accounting treatment is given, it could result in undue profits or losses, which will create an imbalance in our accounting statement, as it will not show a true and fair picture. Remember, we had talked about purchase of weighing machine that would benefit Peter's business for about 10 years. We said that we will distribute the cost or the expense for 10 years when the benefit is expected to be received. Even in that case, we are recording or matching the expense with the year in which we use the asset, or we can generate revenue from it. That example too is related to the matching principle. So to sum it all up, ideally the matching concept is based on a cause and effect relationship, and it requires a company to record or match expenses with related revenues in order to report a company's profitability during a specified time interval. So as an accountant, it is our duty that accounts are prepared on the basis of these generally accepted principles, as these principles would help in giving a true and fair picture of the business. So now Peter understands why it's important to give dual effects for each transaction, and he knows why certain expenses need to be recorded in the year as its related revenues. This was all for the month of September. Thank you. In our previous sessions, we've come across different concepts or principles of accounting. If you have missed those, do check them out by clicking on the links given on the screen. In this session, we will talk on 2 more accounting principles. Now, this is the 7th month of operation in my friend Peter's grocery business, October. Well, a few days ago, Peter was asking me some questions related to recording of transactions in accounting books. So today I've got 2 different kinds of sample reports to show. This one is a family doctor's clinic report, and the second one is the footwear store's report. In this first report prepared, we can see there are cash expenses and incomes. It looks like a very simple report. There are no debtors or creditors, and there are no pending expenses or any prepaid expenses recorded. These pending or prepaid expenses are normally seen with words like outstanding or advance, etc. So this means he has recorded only cash transactions, that is when money either comes into the business or when money goes out of the business. So this way of maintaining your records only when cash or money is received or paid is called the cash basis of accounting. Generally, the cash basis of accounting is used by small businesses who have fewer transactions, or by professionals whose nature of activities is best suited to cash basis of accounting. Its main advantage is that it is readily understood by people with little or no financial or accounting background. Thus, it is easier and also cost-effective method. But this system has certain drawbacks too. What happens if we place an order for a machinery and this machinery is received, but we are given a credit period of 30 days to pay for it? If we follow the cash system of accounting, since cash is not yet paid, we will not show this machinery as a fixed asset, and we will also not record payment to be made for it in future. So therefore, it gives an incorrect status of assets, and we don't know what is the owed amount. In today's world, majority of business transactions are on non-cash basis. This is a major drawback of keeping records on cash basis. Let me tell you another problem that could arise because of cash basis of accounting. So imagine there are 2 scenes here. Let's say we are talking about an electronics business. So there's a customer who purchases a television set for a specified price by giving a post-dated check, which will clear in about 15 days. And the television set will also be delivered within 15 to 20 days. Now, this was the last piece available for that model of television. The television set is packed and it is kept aside for delivery. So the sale has been made, but according to the cash basis of accounting, the sale will not be recorded as cash or money from the customer has not yet come in. Let's see the next scene. Now, after a few days, there is another customer in this store looking for that same television model. Now, that model has already been sold to the first customer physically. and it is already in the delivery stage. But due to no records kept on paper, it may still be showing as available. And the seller may make a mistake of selling that same product twice if goods sold on credit basis but not yet delivered is not recorded in books of accounts. This means cash basis of accounting is showing a wrong status of the stock available. So to avoid such conflicts and confusion, there is another way of keeping accounting records. Let's now take a look at the second report that we have here. Unlike the first report, in this report we can see there are debtors, there are creditors, and we also see the words like prepaid and outstanding. This means in this report, transactions are recorded even when expenses or purchases are pending to be paid, or incomes or money from sales are yet to be received. So all credit transactions are recorded. These transactions are not recorded when cash is coming in or going out, but they are recorded as and when it occurs. That is, when they arise or accrue. So this concept where we recognize transactions on arising or accruing is called the accrual basis of accounting, or the accrual concept. So if my friend Peter purchased goods on credit for $1,000 on 15th October and he has paid for it on 5th November, then according to this accrual concept, when should he record the purchase? Yes, it will be recorded on 15th October, that is, when this purchase was confirmed. The main difference between accrual and cash basis of accounting is the timing of when revenue and expenses are recognized in accounting books. To clarify the difference between the two, let's say Peter sold goods for $2,000 under the cash basis. That amount is not recorded in books until the customer hands over the money or until Peter receives the check. Under the accrual method, the $2,000 is recorded as revenue immediately when the sale is confirmed, even if you receive the money a few days or weeks later. The same thing applies for expenses. If you get an electric bill for $400, under the cash method, the amount is not added to books until you actually pay the bill. However, under the accrual method, the $400 is recorded as an expense in the period the expense relates to or when you utilize its services. So most businesses use this accrual system of accounting to get a true and fair picture of their business. However, some countries have laws which allow to keep their records on cash basis for certain types of businesses, specifically for professionals like CAs, doctors, lawyers, who do not deal in buying and selling of goods. Let's do a little exercise. Can you tell me which system of accounting is used in each of these cases? A business sold goods to Roy on 7th December on a credit period. The business recognizes this sale on 7th December itself. A dentist receives fees from patient $100 on giving services. The dentist accounts for his fees only when cash is received. An internet service provider receives advance of $400 this month for services that he will give in the next month. He recognizes the income in the next month when he will provide services for it. Well, that's all for today. Hope this clarifies Peter's doubts and has also helped you to understand this concept. Thank you. Hi, in this session we'll be learning one new accounting principle, And quickly we will cover up all the other principles that we have come across in our previous sessions. Well, there's one question in the minds of many new accountancy learners, just like my friend Peter's, and that is there a specified duration or dates according to which you must maintain your accounting reports? Now, a business is ongoing and continuous. It is not practical to wait forever to balance accounting books, meaning to collate or finalize these accounting statements. If we did that, we would not be able to calculate the current profit and loss and know the overall status of assets and liabilities at any particular point of time. Hence, we need to close books of accounts at some specific date or interval that could be yearly, quarterly, or even at monthly basis. When I say the word close, it means we do a cutoff of accounting transactions at a particular date. So we choose a defined beginning and an end of a period. Let's say Jan 1st to December 31st, or April 1st to March 31st, or June 1st to September 30th, and so on. So in this closing process, what is actually done is all the balances of each account during this period are posted to a statement called as the trial balance. And then adjustment entries are made, and finally these amounts are posted to the final statements of accounts, which then states the profit or loss of the business. This process helps us to arrive at results of our business activity during this particular period. Therefore, in order to report the periodical progress of a business, this concept of periodicity is developed, which assumes that indefinite life of a business is divided into parts, and each of these parts is called as an accounting period. An accounting period is generally of 12 months, but they are different in different countries and for different businesses. Most of the times, organizations choose to go with the statutory prescribed period in their country, which is also called as a fiscal period, because they need to consider that period for tax and statutory purposes. Statutory meaning legal. Many other businesses like to keep different accounting period due to business-specific reasons. The principle of accounting period helps a business in so many different ways, that is to analyze the performance of business, to compare their reports of any of their previous accounting periods. It helps a business to distribute their income at regular intervals, to calculate tax. It also helps banks and other financial institutions and creditors to know what is the position of this business, and so on. So this was the accounting period concept. I hope my friend Peter has the answer to his question now. So we have come to an end of all the 10 different principles in this session. I hope you're finding this easy to understand. The concepts will get more clear to you as and when we start recording and when we do the actual accounting. We'll be doing a little exercise now based on all the different accounting principles that we've covered so far. Let's begin. Feelings such as sorrow, anger, love, and happiness cannot be recorded in accounting books under this concept. Money measurement concept, which states only events that can be valued in terms of money can be recorded in accounting books. The basic idea of this concept is that business is separate from its owners. Which concept? The business entity concept. Next, under which concept income and expenses are recorded when they are due or they occur? That's right, accrual concept. This concept assumes that the business has a very long life. Which concept? The going concern concept. The concept which states every transaction should have two equal effects. The dual aspect concept. If the market price of a laptop is $800, but the owner bought it on a special sale for $500, at what price will he record the purchase according to the cost concept? $500, as the concept states that transactions should be recorded on cost price and not on the market price. Under the matching concept, the expenses is matched to the period of its related revenues or services. As per this concept, every transaction must be supported by a documentary evidence. Concept of objective evidence. According to this principle, the income is said to be realized when it is received or it is earned. The revenue recognition or the realization concept. And the last one, in order to report the periodical progress of a business, it is assumed that indefinite life of a business is divided into parts called as accounting period. So this is all for today. Thank you. In our previous sessions, we have learned some of the basic terminologies of accounts and learned all the accounting principles. Today, we will go through some very important practices that are essential to follow in order to gain loyalty and to portray a true picture of your business to stakeholders who are very important for the business. These practices are a custom or a way of doing things that is widely accepted and followed, and this is why they are termed as accounting conventions. My friend Peter has read about these conventions, but he wanted a clear picture of what each of them really meant. So let's try to understand each of these conventions. There are 4 conventions in total. The first one is materiality. The word material in legal terms means relevant and significant. Some financial information might be material or relevant to one company, but it might be irrelevant or immaterial to another. This is somewhat obvious when you think about a small company versus a large one. Let's assume there is a company with an annual profit of $1 million. If they misplace some goods from their office worth $2,000, this would be an immaterial thing for such a $1 million company. It would not significantly affect the decisions of different users of the reports or stakeholders. Such losses can be ignored or clubbed together with other expenses in their accounting reports. However, if goods worth $2,000 is misplaced for a company whose annual profit is only $20,000, for them this is a material loss as it is 10% of their profit. Such information could sway the opinion of a financial statement user. Therefore, they would have to account for this loss separately and clearly show this on their reports so that the users can make proper judgment of the company's status. Another example, let's assume my friend Peter's income is approximately $50,000 annually. Okay, so if he spends $6,000 on his rent, it is a huge expense for him, right? But if he spends only $50 on stationery for the entire year, is this a material expense for his business? No. So he could club the expense under general expenses or miscellaneous expenses with other small expenses. The company generally decides what % of their income would they consider to be immaterial, and it is generally around 1%. This was the convention of materiality. Let's move on to the second convention, consistency. Suppose we go to a doctor and she prescribes us a medicine, say for a period of 10 days. We have to be consistent in taking the medication in order to see results and to be able to compare our health to that of the previous day. But if we keep changing our medication very often, or if we just skip them altogether, we will not be able to see the kind of results that were expected. The doctor will prescribe or allow us to take another medication only if there's a genuine reason like an allergy or a side effect. What is important here is being consistent. In the same way, in accountancy, we must maintain a uniform accounting practice. Otherwise, we would not be able to compare the progress of our company with our previous reports. Our reports may not show a true and fair picture of our profits or losses. If at all we are changing any method, the reason for it must be disclosed as a footnote so that users are aware of the changes that are affecting the amounts on these reports. Let's put it this way. To calculate valuation of stock or depreciation, there are many methods that we can use in accountancy. So if we choose one particular method in one accounting period, the same should be consistent in future accounting periods as well. Changes in method are permitted only when the new method follows gives a clear and better picture of the business activities. And also, its effect must be disclosed in the financial statements clearly. There are different rules in different countries regarding this permission of change in method or policies. Moving on to the third convention, conservatism. Do you remember a time when you expected low marks in an exam or expected something to go wrong? You would inform people of concern well in advance so that they do not have high expectations from you. But on the same hand, if you were very sure to get through an interview or score exceptionally well in an exam, you would not go around announcing it until the news was confirmed. The convention of conservatism is similar to this scenario. In a business, oftentimes there's a situation where in future you may or may not incur a particular loss. For example, let's say Peter has given some goods on credit to his neighbor for $500. But his neighbor has suffered huge losses and he needs to even vacate his house. Peter is well aware of his financial condition and so he kind of suspects that the money the neighbor owes him of $500 might not be returned in future. This is called as a doubtful debt. Such kind of losses may or may not arise in future. However, Peter will have to provide for such losses in advance to play a safe game and to be prepared for these kinds of losses if they happen to arise in future. On the other hand, expected incomes or profits are never shown on reports until they arise, until they are confirmed. The business does not want to keep its stakeholders in high hopes and then let them make wrong decisions if at all these incomes or profits do not arise. It'll be like cheating them by wrongly reporting things on their reports that have not happened. So, conservatism should be applied cautiously or prudently, such that the statements do not get distorted. In a way, conservatism calls for the accountant to present the worst-case scenario in the financial statements. This was the convention of conservatism. All okay so far? Let's proceed to the last convention, that is convention of full disclosure. The convention of full disclosure states that you should correctly and clearly disclose all important matters in financial statement reports that would affect a reader's understanding of those statements. You might be wondering what kind of disclosures. Now, actually, this convention is where all the other conventions that we just studied come into the picture. We should disclose if there is any change in the method or policy that we use for calculating or valuation purpose, which might sway the opinion of the user. We learn this in consistency. We should also disclose all relevant material information, convention of materiality. we should disclose all expected, probable, or possible losses and provide for them well in advance. This is the convention of conservatism. It may also include a case filed in the court or a dispute with government entity over a tax position, any important non-monetary transaction, a relation with a company with whom there is a significant transaction volume, anything which cannot be included in the accounting reports but are of great value to the users of these reports. And where is this disclosure made? There is a separate section called as Notes to Accounts or Disclosures below the financial statements in accounting reports, where all these discussed important details are disclosed. This is convention of disclosure. With this, we come to an end of all the accounting conventions and principles. My friend Peter is now well aware of what each of them means. Thank you.
Hey guys! We have seen the principles and conventions of accounting, right? Let's revise it quickly. Remember, if your basics are strong, then no need to worry at all. Today, we are going to test your knowledge on these principles and conventions. So, let's see who will become an accounting expert. So, challenge yourself. Be quick in the first round. So, here we go. Well done. Now let's move on to the next stage. Think and answer. You may take a pause whenever you want. Miss Lucifer uses her company's credit card for personal expenses and recorded in the business books. So what do you think? Which accounting principle is Miss Lucifer violating? A company having a net income of 1 lakh suffered a loss of 100 due to fire. Which concept states that the loss would not affect the overall financial picture of the company? Alex and Company Insurance Building. Insurance company bills 600 every 6 months. One in January, the next in July. Which concept is followed if 600 is paid in month of Jan and recorded immediately? Should I give you the hint? Let's choose 50-50 option. Now it will be easier. Jackie purchases online grocery worth 2000. He made the payment with the help of debit card. On making the payment, which concept allows the seller to record the transaction as sales? As per this concept, assets are categorized into fixed and current. Should we take help of our friend? So here is our friend. Let's see what he has answered. Would you like to go with your friend's answer or would you like to change it? Let's go with your friend's answer. Yes, we got it correct. Here is the last one for you. As per which principle a company is required to report the paid amount of a land in its balance sheet rather than its current market value? Well done. Hope you have enjoyed this ride. Hello friends. Today we are just sitting in our office and we saw a newspaper named Let'stude. It was having news like they are going to introduce Selfie Center, in which they will be introducing new way of learning and other news. The next page was the fun time. On that there are some crossword puzzles relating to accounting. So we just thought that we should try it. These all questions are related to principles and conventions. So first of all, let's revise it quickly. Let's solve it together. We can start solving from anywhere or any point. I'm just going in the order of numbers. So let's begin. The first one is across. Company A disclosed a lawsuit in their financial statement. The suit has not been settled yet. Guess the principal. There is hint also in the question itself. Yes, the disclosure concept. Then there is second down. Mr. Ricky has made sale of 20,000 and he knows 5,000 is going to be bad debts. So for that, he already made a provision. So which accounting convention will be applicable here? The words start from C. Correct, conservatism convention. Then we have again down third. The personal assets of the owner will not appear on the company's balance sheet because of which principle? Think faster. Yes, the entity principle. Then we have fourth one, which is across. A transaction should be recorded in the period in which they actually occur rather than when the cash is received. Which principle states this? So think about the principle. Accrual principle. Then we have fifth one, which is down. Changing accounting principles every year would violate the first three words are CON. Now you can guess the other letters. Yes, the consistency convention. It says that every business should be consistent. Then we have sixth one, which is across. Which concept requires a company's balance sheet to report its land at the cost price rather than its market price? It's very easy. Yes, the cost principle. Then again across. Insignificant details need not be disclosed. Which accounting convention justifies this? Yes, the materiality convention. Then we have across again eighth one. Total assets is equal to capital plus outsider's liability. Which concept applies to this equation? The word starts from D. Let's move to the next one. Company will continue on long enough to carry out its objectives and commitments. Which principle is associated with this assumption? Think and answer. Yes, the going concern principle. And here we have the last one. Profit is ascertained by comparing revenue of the business with its cost. Guess the principle. Correct, it's the matching principle. So with that, here we have completed the crossword. If you guys want to practice, there is one more crossword you can try on your own. And don't forget to read newspapers. Thank you.
Hi. In our previous sessions, we have seen what are the basic terms and concepts, principles of accounting. Now, we all know my friend Peter. His grocery store business is really doing well. And on a daily basis, he has to deal with many transactions. So he wanted to know what are some important things in accountancy which will help him to keep his records in a more organized format and also help him to save time as well as get accurate reports. So in this session, we are going to talk about a very important topic of accounting that will help a business to have organized, classified and accurate reports. That is, classification of accounts. Well, at some point we all must have had this problem of not being able to find the right outfit on time because of having a very messy and clumsy wardrobe, right? Let's say we were finding our favorite black shirt, and we might have even gotten late for work or school because of that. How can this problem be fixed? What if we organized our wardrobe as different drawers or compartments and labeled each one of them neatly? Now is it easier to find that black shirt we were looking for? Of course. Let's try to connect the same scenario to accounting. Suppose we record different transactions aimlessly, anywhere in our books. Can we locate all bank-related transactions easily and answer what will be the bank balance? No. Everything here is jumbled up and we would not be able to find what is the right balance and the right details of any particular account. Therefore, we group all transactions belonging to one category in one account. So if all bank-related transactions are recorded separately under a separate bank account, then we can easily locate all bank transactions and find what is the correct bank balance. Similarly, we will maintain a separate cash account, which will give details about how much cash we received, how much cash we have paid, and how much we will have at the end of one accounting period. In the same way, we'll have a separate capital account, a separate account for Mr. X, salary account, and well, in accountancy, we generally denote the word account by AC. So from what we have seen, we can summarize or conclude that an account is a systematic and summarized record of similar kind of transactions pertaining to one particular person, property, or any expense and incomes. Having understood this first step, let's move on to a very important and very basic accounting concept, which is classification of accounts. Just like we maintain different drawers in a wardrobe and classify them into different heads, in the same way, in accountancy, we will classify different accounts into two types, namely personal and impersonal account. But why do we need to classify them? Because well-classified accounts will help us to make the correct entries and to prepare sound financial statements, that is the profit and loss and the balance sheet. So coming to the first category, that is personal account. Personal. The word relates to a person. So we would have David's account, Philip's account, Jack's account. Accounts having names of people or natural persons. But personal accounts in accounting also includes artificial or legal persons as well. When we say artificial person, in any company or organization, the decisions are made in the name of the company and not any particular person. But the law gives the company certain privileges or rights to be considered as a person. They have a separate legal identity, and therefore all organizations come under personal account. So artificial persons include public limited companies, private limited companies, firms, cooperative societies, etc. For example, ABC Private Limited or Blossom Cooperative Housing Society. There are also certain accounts like, say, the capital account, which represents money brought in by the owner. Owner is a personal account. So capital account is actually representing a person. These kind of accounts are also called as personal accounts, and we call them the representative personal account. Similarly, there is debtors account, which represents all different persons owing money to the business. So again, debtor is a representative personal account. Let's move on to the second category, that is impersonal account. Anything which does not fall into the personal account is an impersonal account. It is further classified into two categories, that is real account and nominal account. Real account relates to the company's properties and assets which are owned by the business concern, like furniture, land, buildings, etc. Now, assets like furniture and machinery and building are tangible in nature. They have a physical existence and they can be seen and touched. But we all must have come across terms like copyrights, trademarks, patent rights, goodwill of a company. All of these can be owned by a business and they have money value, even though they are not physical in nature. These are intangible assets of a business, and these can be found on documents. So the real accounts includes all tangible as well as intangible assets. Next is the nominal account. These accounts relate to all income and expenses, profits and losses. Let's say we pay salaries, or we pay rent, or we pay training fees. Actually, what we are doing here is we are paying money, but they are all given specific names depending upon the reason of payment. Are you getting me? We are paying money for rent or money for salaries. Such accounts like the salary expense account or the rent expense account, interest expense account, or also incomes like commission received account, interest received account, discount received account. All of these accounts exist only in name, meaning they are nominal. Hence, they are termed as nominal accounts. So from all that we have seen, that is personal, real and nominal accounts, what we can conclude is that the items that appear on the profit and loss account or the income and expenses statement consist of all nominal accounts, whereas the balance sheet, which state our assets and liabilities, consist of all personal and real accounts. Peter says he can relate this information to what he is doing, and he can understand his accounts a little better now and keep them organized. Let's have a quick recap of what we have learned in this session. Let's check our understanding by doing a little exercise. Classify these accounts into personal, real, or nominal. Joy's account, cash account, capital account, interest paid account, interest received account, salary account, bank account, machinery account, ABC Private Limited account, goodwill account. So that's all for today's session. Thank you.